I feel like we go from day to day in terms of what comes out of the White House, which is fair and probably accurate. But I'm just curious, do you have a better feel of like, by the end of the year, yeah, there'll be some higher tariffs, but maybe not so onerous, and we'll start to see growth come back. Like, how are you kind of gaming this out?
So you're going to have a baseline of 10% on
no
any
matter
country, right? On any country that you don't have a final deal with.
Which is a lot higher than what it was.
Right, a lot higher, right? So at least 3 times higher. So if we're looking at the average effective rate right now, it's about 12 to 15, depending on how you're counting. If you look at the most recent deal, I think with the Philippines, right, that's a 19% tariff just off of the 20. So while we're seeing some capitulation, right, and some negotiating downward, we could be at some of the same reciprocal levels that we saw on Liberation Day. I think that would be a surprise to the markets. You might get some interim volatility in response, but then it becomes an idiosyncratic risk and sorting through which sectors and industries could be most impacted.
Yeah, I mean, it's just, there's, as you say, right, each market, each country, each industry, it's really specific. And so there's a lot of detail in terms of figuring out the impact. Monica, thank you so much. Really appreciate it. Monica Garish, she is Executive Director, Head of U.S. Policy at Morgan Stanley Wealth Management, joining us here in studio. All right, you are listening and watching Bloomberg Business Week Daily on a day where we've got some earnings coming your way, some big tech earnings, certainly kicking off tomorrow, and we've got markets that are mixed. Coming up, though, we're going to get into 2 stocks caught in the crosshairs of White House policy. That on Bloomberg Business Week Daily continues.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a number of developing stories. SpaceX is warning investors Elon Musk could return to politics. The language about Musk's potential future political involvement was added to paperwork sent to investors discussing a transaction which values SpaceX at about $400 billion. In the meantime, Tesla shares right now, Tesla shares are gaining. Tesla up by 1.1%. We're also keeping an eye on a developing story involving Synovus Financial. That's a regional bank in the southeastern U.S. Sources tell Bloomberg Synovus is weighing options, including a potential merger after drawing interest. Synovus shares right now up by 6.7%. The Dow Jones Industrial Average trading higher by 116 points, up by about 0.3%. We've got the S&P 500 index, a little changed on the day, has been swinging between gains and losses, but right now down by less than half a point. NASDAQ, meanwhile, down 86 ahead of big tech earnings tomorrow. Right now, we've got NASDAQ down 0.4%. The NASDAQ 100 index down 0.5%. Tomorrow, of course, we will be hearing from both Tesla and also Alphabet. The Bloomberg Max 7 index down 0.5%. 10-year 4.33%. The 2-year 3.82%, while the 30-year 4.89%. Spot gold up $33 the ounce, up 1%, and West Texas Intermediate crude down 1.4%, 66.27 a barrel. So again, recapping here, we do have the S&P 500 index trading a little change now, down by half a point. Ozzy Osbourne, the Black Sabbath singer and godfather of heavy metal, has died at age 76. Only weeks after his farewell show. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Few stocks on our radar, including Tesla and SpaceX. Charlie mentioned it. You've got shares of Tesla bouncing around down. Actually, now, is it up about 1.3%? I guess so.
But dipped a little bit right when the headline came out. It was below 1%, but now back to where it was before.
So bouncing around. All right. The other stocks, and I got to say, like, all of these names are feeling the impact of actions by or connections to the Trump White House. So let's get to it. First up, we want to talk about Coca-Cola, which said it plans to launch a new Coke product for American consumers, Tim, made with U.S. cane sugar this fall. It's something the administration kind of wanted them to do.
Shares of Coca-Cola traded down nearly 2% at its lows today. Bloomberg Intelligence senior analyst for consumer products, Ken Shea, joins us from New Jersey on Coca-Cola. Ken, we spoke to you last week. July 17th, you joined us. You also had a note out that said Coca-Cola was unlikely to move completely to cane sugar. I should say you were absolutely right about that. They are not getting rid of high fructose corn syrup. It sounds like what they're doing is coming out with a new cane sugar version of Coca-Cola. What can you tell us?
Yeah, hi, Tim. Well, as we expected, and fully in sync with what Coca-Cola has been saying all along, and that is it wants to be a full beverage company. So if there's a demand for a niche or a segment of the market that it feels they can play in there economically, it's going to do it. And so the cane sugar product extension really of the brand Coca-Cola is no exception. We already know there's a demand for it. Lots of consumers like the Mexican Coke, they call it. Gets imported into the U.S. in some selected markets. There's actually some small competitors that use it. Only small competitors because it's a more expensive version of a sugary drink. High fructose corn syrup is much less expensive. But I think Coke is really smart in bringing this out, not only because it appeases the president, but also because it is a niche product. Coke likes to play in different niches to see what can work and what might not, but it's willing to take a chance. And it's one of a few innovations that it has in store for the second half that I think investors are embracing here.
Wait, forgive me. This is an innovation? Just switching the sugar? And it already makes it, as I know, it's something Tim likes and my husband loves because he'll order it like the Mexican Coke.
Comes in glass, too, which is awesome.
Exactly. So
maybe that's why it tastes good.
Help me understand, because innovation to me is something new and different.
Okay, so maybe it is not a full-blown innovation, but it's certainly a product that isn't mainstream. Let me put it that way in the U.S. High fructose corn syrup versions of sugary drinks, Coca-Cola, have been really the mainstay primary version since the 1980s just because it's less expensive. Most consumers don't know the difference. Some aficionados of soft drinks certainly do. And so I think it's going to be more of a niche product, maybe not an innovation, maybe that's a little stretch, but we'll see how they brand it. In terms of, it's certainly going to be a premium priced product, if for no other reason to cover the cost. But I think it's going to be sold, in some markets like I said, at a premium price. Not all their channels, most of the channels though.
How much more expensive is cane sugar from the U.S. versus high fructose corn syrup?
I would estimate about twice the cost on a per unit basis. That's a rough rule of thumb, but that's generally the way the analysts look at it. And like I said, they've shied away from it. There hasn't been a high clamoring for it until recently. And so they're going to have some fun with it too. They're going to come out with this and they're going to see where it takes them. It's one of a few innovations though. The company is really benefiting, maybe not innovation, but a trend, I should say, of the protein drinks. Again, not a new innovation, but it's suddenly taken off because of consumers are recognizing that it's a great way to have a post-recovery for the GLP-1 drug users. It's a great way to replenish maybe lost protein with the weight loss. There's been a recovery in sports drinks. So these are all areas where Coke's going to invest heavily in the second half to try to keep the growth engine going.
The business, just to tie it up here, the stock is a little bit lower today, but we've been bouncing around. It was a little higher, but it was down as much as 2% at its lows today, but it's now down about half a percentage point. The business at Coke they're massive still, right? They are a big player in the global beverage market, but their business overall, how would you describe it?
I would say today reinforced it's right on track. They pretty much reiterated their growth expectations for the year. Their long-term growth algorithm, as they call it, is for 4 to 6% organic revenue growth annually. And today was at 5%, and they still see 5 to 6 for the year. So it's right on track. With that and a little earnings leverage, they can try to get to mid to high single-digit EPS growth over the longer term. I think investors are pretty much reassured, I would say, today with today's results, solid results.
Yeah. All right. Really appreciate it. And shares of Coca-Cola, we should point out, they're up around 12% year to date. Hey, Ken, thank you so much. Ken Shea, Bloomberg Intelligence Senior Analyst for Consumer Products, joining us in New Jersey.
Does it actually taste better?
I'm not a soda drinker, except for ginger ale when my tummy doesn't feel good.
The only way for us to figure it out, blind taste test. We'll do it.
Let's do it.
Yeah.
I used to like Diet Coke.
Sebastian's going to buy the Coke for us because apparently it's very expensive.
Oh, is it?
The Mexican Coke. Yeah.
Oh, Charlie's giving it 2 thumbs up.
Okay.
All right. So let's go from one iconic brand to another.
Yeah, let's talk a little bit about what happened with General Motors. Profit fell as the company said it suffered a $1.1 billion profit hit from President Trump's tariffs. It revealed no plan for a near-term fix to return to pre-tariff profit levels. David Welch is in our Detroit News Bureau. He joins us from Detroit. He's been covering this company for years. He's been paying attention since early in the morning when that company reported results. The headline we're all talking about is that $1.1 billion hit. Break it down for us. How exactly did this end up hitting GM so hard?
Look, they have a lot of exposure because close to half of the vehicles that they sell in the U.S. are imported. So they're paying a lot in tariffs. There are things that they're going to do to try to mitigate those costs, but they're in the early days of doing that. So you didn't see the impact of that stuff in the second quarter. And even if all of it had come to fruition in the current quarter or in the previous quarter, it would only offset a third of that. So there's a long walk to get to the pre-tax profitability that the company had. And to do that, they're going to have to relocate production of some vehicles, some parts in the U.S. They announced a $4 billion investment, which will do some of that, particularly with vehicles in Mexico. But they still import vehicles from Korea. They're waiting on a trade deal there. It's one of their top sellers, the Chevy Trax. They sell 200,000 of them a year, and it's getting hit with a big tariff on South Korea. So, these are not easy things to deal with. There is no quick fix for it, and you can't just pass the costs on to consumers because they're already paying very high monthly payments because car prices are very high, and so are interest rates. So there's no real way out of that. And they had some other operational issues that had nothing to do with tariffs that also hurt their profits in the quarter. So, all in, it wasn't like it was a terrible quarter without the tariffs, but it wasn't a great one either, and there's no easy way around that.
$1 billion on its own sounds like a lot. $1 billion hit, it's not something a company wants. Is it big in the grand scheme of General Motors?
No, it is. I mean, they're going to see exposure this year from tariffs of $4 to $5 billion.
Okay.
And like I said, they'll offset some of that, but that's a lot here. And so, to put it in perspective, their EBIT, the operating profit for the North American business alone, was $4.4 billion last year, $2.4 billion this year. So, and that's their big profit generator, is that North American business. So half of that hit was tariffs, and there were other things like warranty costs, like building up inventory for electric vehicles, which they're selling more of and trying to really grow as a business. But those vehicles lose money. That's another area that actually hurt profits for them. But that took their EBIT down by 25% in the quarter alone, the tariff hit. So it is a very big deal, and it's something that they just can't easily rectify.
Well, on the rectifying this, David, somebody from the Trump administration, if they were sitting here, might push back and say this is exactly why we have this policy in effect. So the work that is done outside of the U.S. by workers who are not American will be moved to the United States and will then in turn be done by American workers. Is that realistic?
Well, they are going to get some of it back. Look, GM announced a big investment in the U.S., and it's worth 3,000 or 4,000 jobs, making pickup trucks and small Chevy Equinox SUVs that are made in Mexico. They'll still make some there, but they're going to make a lot of them here in the U.S. too, and also probably will take some production away from a pickup truck plant in Canada as well. So it is bringing jobs back. And the other argument the Trump administration would probably make is GM's not raising prices because it's not really clear that they can get a lot of pricing out of consumers. So really, the Trump administration is taxing GM, not taxpayers, not consumers, with these tariffs. So they would say, hey, it's not been going to be this inflationary thing that the critics said, and it's going to raise money for the federal government, and it's just going to hurt somebody's profits and disappoint some Wall Street analysts and investors. So that's the other side of this, and I think that's going to be the case with all the automakers going forward for the next couple of years.
Hey, listen, anything on the call or any questions that are still, you feel like, not completely answered in your mind or in the minds of investors as you reported this story out?
There is an open question about raising prices on vehicles. There's no way they could recoup all of the tariffs by passing those costs on to consumers. It's just too much money. But we have seen other car companies sneak in little price hikes here and there. Does GM start to do that at some point? Right now they're saying they're holding the line and they're not going to do it, but that is what we're really watching with GM and all of its competitors in the next 6 months, is what happens. As we get trade deals, there will still be higher tariffs. What happens with pricing going forward?
All right, going to leave it on that note. Hey, David, thank you so much. Bloomberg News Detroit Bureau Chief David Welch talking about GM and how the current administration policies are impacting the business. As we mentioned, shares of General Motors taking a little bit of a hit, down about 7.3%, so near their lows of the session, Tim.
Back to a headline that you mentioned just in the last few minutes, Carol. SpaceX has warned investors that Elon Musk could return to politics. Musk may serve in similar roles to his previous position as senior advisor to President Donald Trump and devote significant time and energy to such roles, this according to documents. It's great to have back with us Bloomberg Business Week senior reporter Max Chafkin. Max is the co-host of the Everybody's Business and Elon Inc. podcast, also the author of The Contrarian, Peter Thiel, in Silicon Valley's Pursuit of Power. He's here in studio with us.
We
Max,
didn't expect to have you back this soon.
I was gonna say, I feel like,
as much as we love it.
I feel like you knew something here when you told us that you never say never when it comes to Elon Musk and staying out of politics.
I mean, this is one of these things where any investor who's learning this from the risk factor statement of the prospectus is a little bit behind the curve. It's been pretty obvious for about a year that Elon Musk's political activities have a bearing on his businesses, but this, of course, is an acknowledgement of that. And also, I guess, Tim, as you're kind of hinting, maybe a suggestion that Musk has plans to re-enter the fore, although he sort of said as much on Twitter, a week ago when he launched the America Party.
All right, but does this take it to, if he's putting this language in the tender offer for SpaceX, I mean, does it kind of make it even more formal or official? I mean, does it take it to another level?
I mean, we saw these risk factors. I'm less familiar with them as they apply to private marketing fundraising.
Yeah.
But of course, they do show up in public market fundraisings as well. On quarterly reports, annual reports. I just had a quick peek at the last Tesla earnings release back in April. It had 2 new risk factors. One related to essentially perceptions about the stability of the management team, kind of a wordy way of saying negative stories about our CEO, and another about tariffs and a host of other things. So, I mean, I think this is more an acknowledgement of something that Musk himself has talked about. And this is not, I mean, maybe this, in some ways, I guess this is confirmation that people inside of SpaceX are aware that Elon Musk has discussed very recently plans to continue his political journey, and this is a reflection of that.
But how that journey could look might be a lot different than what that journey was over the last year or so, given the
not Doge
very
2.0
public
maybe?
fallout
Absolutely,
that he's had with President Trump. Do you think it would take the form of a new political party and supporting candidates, perhaps Democrats and Republicans, who maybe want to slash the deficit?
Well, we've talked about this a lot. We've talked about this here some and also on the Elon Inc. podcast. I think there are reasons to be somewhat skeptical of a political party in the formal sense, like another effort to start like a reform party or some true alternative. I think the idea of Elon Musk somehow trying to formalize this political movement, in the same way that the Tea Party is not an actual political party, it's like a constituency of voters. You could imagine something like that. And what Musk has said is, or hinted at the very least, is a plan to back certain candidates in the Senate and in Congress, and then try to use that to be, as a sort of point of leverage in negotiations over bills and so on. And I think, there's something to be said for that, right? If he were able to, say, peel a few Republican Senate or House votes away, like that would give him more leverage over Trump than he has now. There are also reasons why this could backfire spectacularly.
All right, let's just remind everybody, as Max has been reminding us, that, he has talked about, kind of staying exposed to politics or staying in politics. We're talking about Elon Musk. In fact, here's what he had to say on May 30th from the Oval Office.
Well, I expect to continue to provide advice whenever the president would like advice.
I hope so.
I expect to remain a friend and an advisor, and certainly if there's anything the president wants me to do, I'm at the president's service.
All right, again, that was Elon Musk there with Donald Trump, the president of the United States, back on May 30th. So, Max, if we read something like this, I mean, who knows? Is it going to be what?
Was that the day with the black eye?
That was the black.
That was
Okay,
the black eye.
I just wanted to.
That was
parenting mishap.
Yeah, sorry. The reason I ask is because you were on our program yesterday.
Talking about
the whole
it.
big take. It's the cover of Bloomberg Business Week. The issue is on my desk.
Right,
Yeah,
and this
it's all
is
about this.
This is
Sorry.
like the
No.
financial filing equivalent of a black eye, right? An acknowledgement that that there is risk here and risk for his companies. I mean, just now as we're talking about this, Musk has been tweeting sort of semi-taunting the Trump administration over reports around the Golden Dome, reports that the Defense Department might look for alternatives to SpaceX. So he's obviously moving into a sort of different position relative to the Trump administration. I'd say it's kind of similar to the one he had with the Biden administration, although, of course, Musk's politics have changed quite a lot since then.
Yeah, I guess that's what I was curious. Like, is it that he's going to go back and become buddy again? Or like, we just don't, like, in what form? Or is he kind of like this and just figuring out a different involvement in
Well,
US
I mean, I
politics?
think Musk has carved out an identity that puts him to the right of President Trump on a whole bunch of issues. You brought up the deficit, but of course he talks all the time about, identity politics, about sort of cultural issues, always, taking a more or less right-wing position. And that's kind of where his fandom is. And that to the extent that he has a political platform, I'd expect it to be, a right-wing platform, further to the right than the Republican Party for sure. But of course, there's also an element of self-interest, right? Where a lot of his positions coincide with the interest of his companies. His companies, as I've said a bunch of times on this program and others, are either heavily regulated by the U.S. government or dependent on government contracts. So it's going to be my guess and my supposition would be some combination of Musk's own political interests and fixations, along with self-interested policies. So you could imagine very conservative on cultural issues, perhaps, but probably like a little bit less conservative on the question of funding green technology companies and so on, because of course that's what Tesla is to some extent.
We'll see. I don't know.
Yeah, day by day.
Hey, this is a great story, though.
Yeah.
Dana Hull, Lauren Grush, Ed Ludlow, SpaceX warning investors that Elon Musk could return to U.S. politics. Max, before we let you go, is this more the lawyers covering themselves than it is an indication that Musk is going to have a new adventure? I
think more or less. And I think anytime you see something like this in a filing, obviously lawyers, as much as Musk has a stated view that is not super positive about lawyers, my assumption here is that this is lawyers and investor relations types trying to cover their bases.
He signs off on it,
of course,
right? Yeah. So he's all in on this as well. Shares of Tesla, by the way, they're up about 1.8%. So one of our metrics on this. Hey, be ready. Have your pager or whatever the heck ready, because we may call. I know.
The Max signal.
Your Starlink up and running, because we may reach out to you again. Of course, that is Bloomberg Business Week senior reporter Max Chafkin. He's co-host of the Everybody's Business and Elon Inc. podcast and the author of The Contrarian.
Stocks are moving a little higher as we speak. Let's get an update from Charlie Pellet. He's got his eye on everything happening in the markets. Hey, Charlie.
Thank you very much. Here's what's going on. S&P 500 index higher now by 6 points. That is a gain of just about 0.1%. We've got the Dow up 150, higher by 0.3%. Traders gearing up for the start of the mega cap earnings season. Right now, though, NASDAQ tech stocks trading lower. NASDAQ down by 0.3%. NASDAQ 100 index down 0.4%. Alphabet, which reports tomorrow, up 0.5%. Tesla, which reports tomorrow, up 1.8%. The Mag 7 index, though, down 0.3%. 10-year 4.33%. The 2-year 3.82%. Gold up $33 the ounce, up 1%. West Texas Intermediate crude down 1.5%. Briefly, number of defense companies reporting earnings. We have got Lockheed Martin plunging 8.5%. RTX down by 1%. Northrop Grumman up by 9.7%. So again, U.S. stocks trading mixed. S&P 500 index right now higher by 5. That is a gain of 0.1%. Ozzy Osbourne, Black Sabbath singer and godfather of heavy metal, dead at the age of 76, only weeks after his farewell show. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Hey, Harvey Schwartz, he is the chief executive of the Carlyle Group, finds himself at the center of a Wall Street revolution. So writes our Sonali Basic. You've got Carlyle shares outperforming rivals this year as the private markets industry takes on traditional lenders and attracts clients who have otherwise gone to firms like Goldman. Schwartz, by the way, is the subject of the 6th episode of the first season of Bullish. Hard to believe it's wrapping up already, with Bloomberg News global finance correspondent Sonali Basic. It is also the season finale. It is on Bloomberg TV tonight at 6 p.m. Wall Street time and on Bloomberg Originals at 8 p.m. Wall Street time. And you can find it already on the Bloomberg Terminal.
The episode already live on the Bloomberg Terminal and at Bloomberg.com/bullish. Sonali's here in the Bloomberg studio with us. I want to get to the episode in a minute, but first give us background on the Carlyle that Harvey Schwartz inherited when he joined as the CEO.
It's a good question, because remember, Carlyle was a firm that tried to do a succession plan, and the CEOs they chose, one ended up being Governor Youngkin, so left Carlyle, and the other had also left the firm. So when they looked for a new CEO, Harvey Schwartz came in. The stock was lagging behind rivals with all of this management change. This year it's doing really well, actually. It's up 18% or so, where a lot of the rivals are down. So there is a lot of sign of progress. But you have to remember, this is an industry changing very, very quickly.
Right.
The private equity industry in particular has kind of gotten a tough rap, but they have been pivoting further and further into credit. Private credit has been a bigger thing for a lot of these companies, as well as private wealth. So expanding access to the private markets to individuals at the brink of them possibly becoming more available in 401ks. So that's kind of what's the backdrop to all this.
You covered so much ground, but on the private markets, you guys, the two of you, you and he talked about some of the concerns, especially amid that explosion in private credit. Here's a little snippet of Bullish.
So one of the great things about the industry is And one of the things I've loved about it is it's constantly reinventing itself and constantly evolving in terms of what is the most efficient way to provide capital to an enterprise. And that's why private capital has grown. Now, more people want access to being providers of that capital. And I think this is, again, just a part of the natural evolution of how people access capital. We haven't opened up that marketplace in a way that gives a broader community access beyond the wealthy. And obviously it should happen. It's actually happening indirectly. Retired teachers all over America participate in plans for which Carlyle is helping those plans manage their assets.
Do you worry that maybe this industry could fly away a little bit if there isn't a bigger set of eyes on it?
Do I think we could have a bad credit cycle? Sure. The question is it systemic in that it actually triggers a broader crisis? Banks have failed, but we haven't seen credit funds fail.
And that, of course, is Harvey Schwartz, the chief executive of the Carlyle Group, with our Sonali Basak and the season finale of Bullish, which airs tonight on Bloomberg TV at 6 p.m. Wall Street time. You know, okay, not yet. And I feel like everybody who's in that market is just like, you know, the pros and cons. And we haven't seen a credit cycle or private credit cycle fail, at least not yet.
Yeah, it's certainly in the minds of a lot of investors. And, you know, one argument the private asset industry will say, of course, is that it's not deposits that they're taking here. And what I'm hearing, you know, just a little bit of color behind the scenes, is there isn't a lot of concern about the biggest firms. But remember, this has become not only a very crowded space, and Carlyle is one of the biggest, but the asset class of just direct lending is actually already bigger than the syndicated loan market. So that's just the scale of how big it's gotten, and it's quickly catching up to the high yield market too. So just enormous numbers we're talking about here.
A big focus for this firm and the other firms that are in the space and so-called alternative asset firms rather than private equity firms has been private credit. What about the original private equity though? Is he moving away from that at all?
So Carlyle, and I'll also include Blackstone and Apollo and KKR. There are private equity businesses. They're just becoming a much smaller percentage of the whole pie. And so private equity, the question is, how quick can they monetize assets? Interestingly enough, Carlyle has kind of been one of the first out of the gate here to start to IPO companies, start to get back in and buy and sell companies. I would remind everyone too that, you know, KKR in the market doldrums in April spent billions of dollars in like a week, right? So private equity is not over, but there's certainly a lot of questions. A great story on the terminal today about how mid-sized private equity firms are facing a lot of struggles against these massive giants in the room. If you can't write big checks, it's kind of tough to play in the space.
I know we've run out of time, but 30 seconds. It's a very personal story. You also get into him, and you talk about his parents who dealt with serious mental health illness. It made me stop. Just a little teaser for those folks who are listening, because it's what's going on at the firm, but it's also his story.
The most unusual story that I've heard on Wall Street, particularly for a CEO. And he does talk a lot about mental health because of the struggles he had growing up. The high school we went back to, he actually failed out of. He never graduated from there.
Right.
And so he and a few others that I've interviewed have one big theme, which is knowing your luck and being able to take advantage of that luck. And it's worth a watch for anybody who's entering Wall Street.
Incredible reveal and very, very deep and personal, no doubt about it. Sonali, thank you so much. Really appreciate it. Bloomberg News Global Finance correspondent Sonali Basak. Catch the season finale of the first season of Bullish featuring Harvey Schwartz, the chief executive of the Carlyle Group. All right, when we come back, we'll get a check on trading for you and some stocks on the move. You are listening and watching Bloomberg Business Week Daily. I'm Carol Massar, along with Tim Stanovic. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec. Bloomberg Radio and Television.
All right, everybody. Carol Masser, Tim Stenovec, and we are just coming up on about an hour to go until we wrap up trading on this Tuesday. And stocks have been bouncing around a little bit today. We're back up near our best levels of the session. We're back in the green, so we're looking at maybe another record on the S&P 500. We're up about 9.5 points, 63.15. You've got the Dow up 174 points. Not so, a lot of big tech names are dragging down the NASDAQ 100 today. Tim, you've got the NASDAQ 100 down by 83 points.
We'll see what happens tomorrow after the bell. Tesla is set to report results, so we might see a big move there. We'll also hear from Alphabet after the bell. So we'll see, Carol, if those kind of change the narrative around what we've seen so far. It's early.
Yeah, it is early, but right, these will be very important in terms of sentiment and momentum. I'm Carol Masser along with Tim Stenovec. So let's get to some stocks on the move today. With us is Bloomberg News equities reporter Nora Melinda. All right, Nora, stock number one.
Plethora to choose from today, but I'm looking at shares of D.R. Horton. That's ticker DHI. This is one of the stocks that I actually cover. It is a home builder, and it's one of the bellwethers in the industry. We're seeing shares up this afternoon, and this is after it reported orders that topped expectations and a third quarter EPS beat. And so this is really good, especially if you think about the sluggish housing market. This is great news for the sector. So we're seeing a widespread rally coming off of this, as we're seeing a lot of these other companies like Pulte Group, which also reported earnings, rising in sympathy here.
What's the good news, though? I mean, is it because if we...
I know, right? What is the good news?
Well, if we take what we heard from the president earlier today about interest rates and about people not being able to afford homes as a result of that. Rates are still high. There are concerns about construction costs, so I guess expectations were not high.
I mean, there's definitely a lot of overhangs right now when you think about the broader real estate industry, but particularly residential real estate. And we know that D.R. Horton actually targets some of the entry-level buyers and the move-up buyers. And it's interesting because if you think about the average, millennial or people who are looking to get a new home, I don't really hear that many people saying that they're closing. So it's interesting that we are getting these results, but we do have Zelman, the analyst there. They're pointing out that while this was a solid report here, we did see that management tweaked the midpoint of its 2025 revenue and closing guidance. That's a little bit slightly lower. So we do have analysts that are really still trying to see if they are still offering these incentives, because they used to do a lot of these buy downs where they would buy down the rates to make it cheaper and, throw in a dishwasher, throw in some fun things to make it make more sense.
You buy points and so forth, right? Oh God, she was aggressive and really smart. But, I should point out that home building stocks as a whole, they're up about 10%. So investors taking note.
Quite a day.
That you had D.R. Horton and Pulte, right, both come out with some news that has caught the attention of investors. All right, let's go to stock number two. Where do you want to take us?
Let's go to Lockheed Martin. This is the other industry that I cover, aerospace and defense companies. So we're seeing ticker LMT. That's the worst performing stock in the S&P 500 today. Really seeing a decline. It was earlier down as much as 10%. That's the biggest drop since October of 2021. And we're seeing a stock that's down about 14% so far this year. But what people are really taking away from these earnings today is the fact that it had a $1.6 billion amount in charges and a possible tax hit. And that's what's really sent the stock tumbling. But we do see a lot of the things that have really been a headwind for the stock is the fact of the criticism that it's really been receiving regarding its F-35 jet. So lots of cost overruns and delays that has really been riddling the company here.
They also didn't get the F-47. That was the new plane that was announced back in March, I believe, that ended up going to Boeing instead.
No, absolutely. So, I mean, there's a lot of things that people have really been parsing as it pertains to this company, and it seems as though Wall Street's quite critical today, but not super surprising because I think people had expectations that were kind of low coming into aerospace and defense earnings. We do see Northrop Grumman as a gainer right now, but overwhelmingly, you are seeing a bit of people sour right now when it comes to aerospace and defense.
Potentially $4.6 billion in additional taxes owed after an accounting change. And apparently, I guess they're talking with the SEC about this or contesting the matter with the Internal Revenue Service. But I mean, whoa, that would be massive.
Absolutely.
Massive.
I mean, we're looking at the stock
even if
that's
it's a
down
one-time, but
yeah. I mean, I think that these are some really interesting things that it seems like people are really pointing a finger, poking here.
All right, let's poke at KSS.
That was a good one.
Thank you.
Yes, so we're looking at shares of Kohl's, and this is interesting because we've really been seeing this meme stock rally returning. Another company that I cover is Open Door Technologies, that's ticker Open, and we're just seeing a wide-based rally right now between Kohl's and Open Door. But let's look at Kohl's here. We're actually seeing this, of course, because of social media chatter, as is typical when we think about these meme stocks here. We're seeing shares that doubled, more than doubled this today throughout trading. And we are seeing shares that are up about 86%. That's insane as we speak right now. But we are seeing it fading a little bit, earlier up as much as 105%. But this is really just Kohl's ripping right now. And a lot of people are pointing back toward that 2021 meme stock script that we were seeing played out with GameStop and, of course, all the others.
49% of the float is short interest.
Yeah.
Just saying.
You always bring up the short interest, Carol.
I know,
As
because it's like, it tells a story.
So-
It does.
It means investors are not all in.
Last week,
Or they might have to do a bunch of short covering.
crypto assets hit $4 trillion, Bitcoin around all-time highs, meme stocks are being memey again.
Is this an everything is awesome
What's going on?
kind of moment for,
I don't know.
for us? It is kind of fascinating to watch. Nora, thank you. Bloomberg News equities reporter Nora Melinda. Hey, for more conversations like this, be sure to check out our Stock Movers podcast, 5-minute episodes, biggest winners, biggest losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, coming up next on Bloomberg Business Week Daily, we are talking meme stocks. The guy who set off the frenzy with Open Door, the hedge fund manager, joining us next.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. A heavy metal giant has died, Ozzy Osbourne. CBS's Matt Piper has a look back at his long-running and varied career.
Ozzy Osbourne rose to prominence during the 1970s as the lead singer of the heavy metal band Black Sabbath. The so-called Prince of Darkness caused an uproar for biting the head off of a bat, but he was able to show his lighter side when a reality show about his family premiered on MTV back in 2002. While his music resonated with heavy metal fans, on the show, one of the first in the reality TV world, his kookiness did.
The cooking channel. The bake your own bread channel.
Ozzy Osbourne, the godfather of heavy metal, was 76. Matt Piper, CBS News.
There is more international outrage over the hunger situation in Gaza.
Gaza has become hell on earth and no place is safe.
The UN's Juliet Touma, the Gaza Health Ministry, says 33 Palestinians have died of malnutrition, including 12 children, in just the past 48 hours. Correspondent Elizabeth Palmer.
Gaza is hungry. Not just the vulnerable teen with a head injury who needs special supplements, but his mother and whole families, and even many of the medical staff just aren't getting adequate calories. Victoria Rose is a surgeon who was working in Gaza until last month.
Still in constant contact with many of my colleagues that I worked alongside in Gaza, those who are alive, and it's very difficult to listen to them tell me how hungry they are, how they've not been able to feed their children.
The UN says doctors are fainting from hunger. Deputy Attorney General Todd Blanche said he wants to interview Jeffrey Epstein's former girlfriend, Ghislaine Maxwell. CBS's Aaron Navarro has more from the White House.
Maxwell's attorney said in a post today that they are in discussions with the federal government, said that Maxwell would, quote, testify truthfully, but had nothing else to add in that comment.
Jim Krasula has the latest on the brutal heat and humidity stretching across much of the country.
It will feel like 110 degrees in places from
Kansas City, northeast to Milwaukee, and south to the upper Gulf Coast. Skylar Moss manages landscape crews in Memphis, Tennessee. Extreme heat may prompt her to change schedules.
I try to encourage my guys to take as many breaks as they feel that they need, and if it's just like absurd, ridiculous, then we can move things around.
Midweek temperatures across the middle of the country will be 10 to 15 degrees above normal for this time of year.
On Wall Street, stocks are mixed. This is CBS News. Getting the kids ready for back to school, Jennifer Kuiper reports the shopping only adds to the anxiety.
Some 30% of back-to-school shoppers for the upcoming school year say inflation is changing the way they shop, according to a new Bankrate survey. That's down slightly from 32% last year. Fewer Americans also say that back-to-school expenses are putting pressure on their finances. 20% say the costs are straining their budgets, down from 31% in 2022.
Many shoppers say they're still looking for deals and are likely to choose the cheapest brand. GM is the latest automaker to report a sharp drop in sales, down 35%. Tariffs on imported cars and auto parts took a $1 billion bite out of its bottom line. The company's warning the impact of tariffs could be even greater next quarter. And Treasury Secretary Scott Bessent said today he'll meet with his Chinese counterparts next week with the possibility of extending the tariffs deadline. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec. Live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone. We are 55 minutes away from the closing bell on Wall Street. We've got a few earnings coming your way after the closing bell. In the meantime, we've got stocks they've been bouncing around. Right now, though, we are off, Tim, our lows of the session. In fact, close to our highs on the S&P 500. If we close with any kind of gain, we would see another record.
Up 1% over the last 5 days. Few records. Well, you were gone too, Carol.
I know.
We'll have more from Charlie Pellet in just a minute. Speaking of stocks, it seems like it's kind of like a party. Like it's 2021. The meme stocks are acting like it. We've got the hedge fund manager whose social media posts set off a frenzy in shares of Open Door. Eric Jackson is going to be joining us in just a minute.
Stock moving around a lot, no doubt about that. Hey, also, is it the end of late night television? The guy who wrote the book on HBO joining us on Colbert's cancellation. Who could be next? What it all means? And I don't know, why is it all happening? Is it, I don't know. We'll ask questions.
And we're joined by the mayor of Gary, Indiana, who says that Nippon Steel's acquisition of U.S. Steel will actually be a major boon for his overlooked city.
Yeah, it's a city that's really fallen on hard times.
Yeah,
so
it is.
Curious to see where they are and what programs are working. All right, lots to come over the next 2 hours. Let's get to the trade and a look at some of the business stories that are topping the Bloomberg. Let's toss things over to Charlie.
Hi, thank you very much indeed. We got 54 minutes to go until that closing bell clangs on Wall Street. Stocks rising toward a fresh record. More than 400 shares in the S&P 500 are rising as investors parse the latest tariff developments, also prepare for the start of mega cap earnings season. Tomorrow, of course, we hear from Alphabet and also Tesla. Right to the numbers. S&P up 6 now, up 0.1%. The Dow up 156, up 0.4. NASDAQ down 58. For NASDAQ, a drop of 0.3%. 10-year 4.33%, with a 2-year currently yielding 3.82%. Gold up $32 the ounce, up 1%. And West Texas Intermediate crude down 1.5%. WTI 66.21 a barrel. Coca-Cola shares lower right now. We've got Coke stock down by 0.7%. It did post second quarter sales growth and profit that beat Wall Street expectations as consumers continue to pay higher prices for the company's soft drinks. Victoria Fernandez is chief market strategist at Crossmark Global, and she says the job market is key to consumers' willingness to pay more.
When wages start to really slow down, then I think you're going to see people go, wait a minute, how secure is my job? Maybe I start to pull back. Right now, they're not feeling that pressure, so they're willing to spend more and pay more for the things that are important to them. I think we could see that change in the fourth quarter.
Crossmark's Victoria Fernandez. Coal shares surging, minting it as the newest meme stock amid an influx of mentions by retail traders on social media. We got a whole lot more on Coal's KSS on the ticker. That stock surging now by 38.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Well, it does kind of feel like 2021, at least some vibes, with meme stocks and crypto back in the spotlight. Coal shares more than doubled amid an influx of mentions by retail traders on social media, with the stock price soaring as much as 105% when the equity market opened today. And then there's Open Door Technologies. It jumped as much as 120% yesterday. It extended its gravity-defying rally from last week. Investors continue to pile into the stock that has found a sudden fandom among retail traders and social media platforms.
I mean, this is one that is certainly on our radar. One of the reasons Open Door has been moving is due to Eric Jackson. He's the founder of Toronto-based hedge fund EMJ Capital. He made a series of posts on X encouraging buying, and Eric joins us from Toronto on this Tuesday. Eric, good to have you here with us. Do you, first of all, take issue with this being Open Door, a meme stock?
Yeah, I think, Carol, that all the meme stocks from 2021 were dumb businesses. I couldn't understand it at the time, why retail traders were getting so wrapped up in AMC, GME, and BlackBerry. I think those were the big three. Those are all like Walking Dead businesses. So when I got into Open Door, and then I first started tweeting about it last Monday. It's hard to believe. It feels like a century ago. Like 2:45. Like, I got into it because this is a real business, and it's got a real platform that it's built, and it's definitely fallen on hard times. That's why the stock's down like 99% or whatever it is from its all-time highs. But I just think that the market got overly pessimistic about it. And I've seen this movie before with Carvana. Like, that's one of my greatest heads on my wall, I guess, from the past, is that I got into Carvana early, not at $3.50, but at $15. And today it's like close to 400. And I just see so many similarities between these two businesses. And all, people just get overly prisoner of the moment, pessimistic about these companies, and everyone's negative Nelly, and everyone loves to dance on the grave and say that these companies are circling the drain. Nobody would have believed that, at 350 that Carvana was going back to 400. Mm-hmm. Nobody can believe now that at it was 70 cents last Monday. Now it's whatever it is, $3 today. That this thing is, I think, going to $82.
Yeah. Okay, so let's talk about that. It's $2.80 right now, down about 13% as we speak, just on the day today. You have a price target of $82. That's pretty wild. Make your case to us on why you see it moving that high.
Well, I'll be even wilder, Tim. I think today it should be trading at $40. Basically, if you go back and look at Carvana, okay, use this as a comparison to Open Door. Both of these companies, they're trying to e-commerce-ify some niche that hasn't been e-commerce-ified before. For Carvana, it was buying and selling used cars. For Open Door, it's buying and selling homes. It's a huge business, obviously, in both cases, a national business. where just having like 1 or 2 or 3% market share nationally, is talking billions and billions of dollars and power, like, because it's all so fragmented today, with the dealers in the car industry and with the agents, in the real estate industry. Basically, you need a lot of debt to run both of these businesses. And so the problem that both of these businesses came upon is that although they were flying high in the pre-COVID and then briefly post-COVID era, when interest rates were low, when Powell started raising rates, suddenly investors got nervous and these stocks crashed. And the assumption was that they're going to go under. They're going to file for bankruptcy. So they're priced as if they're going to go bankrupt. And I don't believe that's true. Carvana, in fact, I was on a podcast in June of 2022 with Josh Brown and Michael Batt, where I called both, like I said, both would turn around. Carvana did, and Open Door didn't. I was dead wrong. Like, it took a lot longer for them to get to the point where they're about to turn profitable, but they are about to turn profitable.
So for Open Door, do you expect to inject and invest more money into it and then take a profit? Or because it sounds like you've done the research, looked at the business, maybe talked to the company, that this is more of a long-term buy and hold strategy for you? Which is it?
Well, I've been fortunate to be early on a bunch of companies. Like, I was like really early on Alibaba, even, back in 2009-10 when it was still a private company. It was valued at 10 billion. I thought it was going to go up. Carvana, some other ones. Like, what I've learned, Carol, is that, it's always hard to not avoid the temptation of firing up the terminal or turning on business TV and getting emotional about the macro headlines of the day and get shaken out of these positions. And sometimes when these companies are pretty rare, that can truly 100 bag or 100x, right? Mm-hmm. But it's so easy to get shaken out of these positions. Or like in the case of Carvana, like I said, I got into it at 15. I would say I got out of it, the bulk of my position in around probably 130, 140, 150, somewhere in there. And I'm thinking, oh, I'm so smart. I made 10x my money. Pat myself on the back here, and I know this company really well. I still was optimistic about Carvana and still am today. But I thought, I'm just going to trade in and out. And, the truth is you don't make as much money as if you do nothing and just let it sit there. So I'm not jumping into to add more, Carol, but, because I want to see how the things play out. But I'm going to try to avoid that temptation and just sit and do nothing.
How much?
Until 82.
Can you give us an idea how much you have put into it? And is it all your money? Is it investor money?
Well, I run a fund, Carol. It's a small fund. I'll be frank with you guys. It's I had a huge billionaire that basically was like a cornerstone investor for me in 2016, 17 when I started EMJ Capital. And he said, I like the way you think, Eric. You look at companies differently. You find these little hidden jewel companies. How about I give you some money to manage? And I did, and did great. It was kind of like a Kathy Wood type arc, 2017 up to, probably February 2021 was amazing, shot the lights out. And then 21 and 22, I got crushed. And I didn't diversify my, customer base, and so 99.5% of the capital in the fund was this billionaire. And he took it out. And which was his right, and he's still friendly with him, but I was sort of left scrambling and trying to figure out what to do, and so kept the lights on, pivoted it to building a team to build AI models, but it's been hit and miss the last few years, and then it was only probably 3 months ago that I realized hey, we're doing, I keep finding these companies. Why don't we just sort of go all in on that? Let's get the AI models totally focused on finding these 100 baggers before the fact. So the remaining capital we have, which is a few million, we put in, obviously we didn't put it all into Open Door or anything. We have other positions. There's sort of 5 key positions that I have right now: Iron, Cipher Mining, BTQ Technologies, and Ethereum. Those are the big 5. focused on, and we'll see where we go. And
Eric,
like all I got is my reputation, guys.
All right,
and,
no, we get.
But now I've got people, whatever, calling up or emailing and saying, this is great. We want to get behind you. So we'll see where it goes.
It seems like a lot of folks on social media, are getting behind you. Have you talked to Chamath Palihapitiya at all about this? He is, had famous involvement with Open Door back when it went public.
I haven't talked with him. I not emailed, but I texted, or not texted. I tweeted him when this thing got started last week, because obviously I think it would be a tremendous redemption arc for Chamath to come back into this stock. I don't think he has anything to be ashamed of being involved with Open Door to begin with, or any other co-founder. Like Keith Rabois is a guy who kind of wrote the business plan originally. I think he's like one of the smartest guys out there. Everybody who was associated with this company was, it was a good company. It's just the macro changed and the rates rose and stuff, and so I don't think Chamath has anything to be ashamed of. But I think it would be amazing if he came back in on the ride to 82, which would double the all-time highs, which is previously $39.
Eric, forgive me for being blunt about this question, but if you look at your Twitter feed, there's just it's like all Open Door. I mean, I had trouble. You're spending a lot of time retweeting and interacting with folks on there, and I understand that that's part of the game these days, but maybe a critic could see that and say, you're really trying to just pump this stock up at this point. Defend it on its fundamentals, and convince people that this is not, for lack of a better term, pumping it up and then selling.
I don't know what to tell you guys. I mean, unfollow me, Tim, if I'm bugging you. Mute me or block me, and I'd say that to anybody else. I think anybody who knows me knows I'm not a pumper or whatever. I mean, I've been inundated, called a pump and dumper, a grifter. Jim Cramer said this was a parlay yesterday. I don't know what that means. You could explain it to me. Whatever. I mean, people are, they're not familiar with the Open Door story. So whatever, they want to sit back behind their anonymous Twitter feeds and cast aspersions. I don't care. I'm here to make money. I got to feed my family. I got to grow this business. I got to do well for my investors. And if people want to take shots, whatever, I just don't have time for it. I really love the community that we've built. I mean, it's amazing. This morning I was retweeting all these people from, you name it, Turkey, Korea, Japan, Africa, Nigeria, Brazil. I mean, everyone around the world, and they're all in on Open Door.
Yeah.
I don't know that it's going to 82. I don't have a crystal ball. I might be wrong. I was wrong for many, many years about Open Door, but I don't think I'm wrong right now. I think now is the time. This thing is turning, and you can either get in, make a lot of money, or not. And I got people already telling me how much money they've made, and it's life-changing and all this. That's fantastic. I mean, it doesn't help me, but I'm happy for them. And this is a community.
Eric, you did say
we learn together.
No, I hear you. You said you're hoping to hold on to it, like that's your plan. But I mean, if all of a sudden the stock took a downturn, I mean, it's a $2.84 stock, so I'm not quite sure what kind of downturn. But is there something that you would quickly change your thoughts, or you're going to ride it, even if it rides down a lot?
I can't say I'm going to ride it forever, Carol. I mean,
not forever, but I mean, if it went down 50%, would you stay with it?
I think it's less about the percentage drop. I mean, there's obviously going to be volatility, especially in the early days of these kinds of names. And, they report earnings in a couple of weeks. So, if it's a terrible report, I mean, this thing would have a negative reaction to the downside, and then reverse to the upside. If it was good news, I think it is going to be profitable. And I think it's going to be the start of a string of profitable quarters, which is what needs to happen for this thing to get up to 82. But one thing that's different about Open Door is like there is more diverse opinion about management. I think with Carvana, like obviously everybody on Twitter and Wall Street hated it, but if you talk to people that actually knew the business, I think people really admired the CEO Ernie Garcia and the management team, and those guys bought a lot of stock when Carvana was low, right before it bottomed. Nobody's done that here at Open Door, which is the norm for most of these. I mean, most times these insiders, they just don't. Brian Armstrong from Coinbase never bought a share from the time he went public at 400 down to 38, back up again. He just sell. buy a house in LA. So, but there's more controversy about the management here at Open Door, Tim. Not to cut you off.
Yeah,
but,
that's okay.
You know, some people think Carrie Wheeler, who's the CEO, is great, and some people don't. And so, if I discovered 3 months from now that, gosh, I don't know about her. I mean, one thing I might think about is like, what's the chance of an activist coming in here, which I think is very high. So that might keep me in. But if I concluded like the management's terrible, I can't stand it anymore, then obviously I'd have to exit. I don't think that's going to be the case.
Eric, before we let you go, other stocks that you are buying right now, that you're holding right now, what are people missing and what are you getting?
Earlier today, Tim, hot off the presses, I tweeted this out already. So this is, I bought some Iron, IREN, and Cipher, CIFR. Both of those are Bitcoin miners. We make a lot of money from that, but they're more excitingly, they're kind of like a Core Scientific, and just, you know, CoreWeave bought Core Scientific recently, but it was kind of a lousy price for Core Scientific. Iron and Cipher are way bigger, have way more kind of energized gigawatts that are coming online in the next year that somebody like an Oracle or a Meta or a, you know, Google has to do a deal with. So I like those, and I like BTQ Technologies. BTQQF is the ticker. It's still an OTC ticker. I bought it at 21 cents in December. It's now at like $5, so it's been a 30 bagger for me so far. But I think it's gonna meet the criteria and be a 100 bagger when all said and done.
All right.
Always looking for the diamonds in the rough. No matter how low the prices are. Hey, Eric, appreciate you taking so much time with us this afternoon. It's great to check back in with you. It's been quite a few months, so we love it that you took the time. Eric Jackson is the founder of the Toronto-based hedge fund EMJ Capital. I would never block him on Twitter. I still follow you on Twitter.
No.
Check out his Twitter feed too, because he does share a lot of what he's working on there as well.
Yeah, pretty clear and pretty transparent and stuff out there. All right, our thanks to Eric Jackson. In the meantime, one of the things that we've been focusing on, you know that we've talked about it, is what's going on in the home building space, because you've got the S&P 500 composite home building index up almost 10% in today's session. This is coming off of earnings from Pulte and D.R. Horton. We're going to talk home building in just a moment, because it's definitely an area that we've been watching today.
First up, though, check the day's trade top business stories. Here he is, Charlie.
All right, thank you very much. And here's what's going on. We got the S&P 500 index trading at a record. Just talking about Kohl's, though, that stock surging 37%. Also talking about Open Door, and Open Door shares, they're down right now by 10%. S&P up 7 at a record, up 0.1%. We got the Dow up 168, up 0.4. NASDAQ, though, in the red, down by 0.3%. 10-year 4.33%, with a 2-year 3.82%. Gold up $34 the ounce, higher by 1% right now. West Texas Intermediate crude down 1.5%. WTI right now trading at 66.21 a barrel. Microsoft down 0.9%. Microsoft is accusing Chinese state-sponsored hackers of using flaws in its SharePoint document management software in a hacking campaign that has targeted businesses and government agencies around the world. Again, recapping, stocks higher, S&P up 7, gain of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie. Appreciate it. Well, D.R. Horton now with earnings rallying as much as 15% and a top gainer in the S&P 500. From the Oval Office today, the president took a question asking about the possibility of having no tax on capital gains on homes, and the president said he's thinking about it.
It would also unleash you just by lowering the interest rates. If the Fed would lower the rates, we wouldn't even have to do that. But we are thinking about no tax on capital gains on houses.
No tax on capital gains on houses, Carol Master.
Sign me up.
Yeah, I knew you were going to say that.
Sorry.
So you just sell the house, keep the money, and then, where are you going to live?
It's okay.
Got to buy another house then.
Yeah, I hear you.
Okay, let's talk housing in the U.S. Back with us is Thomas Carroll, founder and CEO of Ballast Rock Asset Management. The firm's got about $600 million in AUM. It focuses on multifamily real estate and also on private equity. Thomas back here with us in the Bloomberg Interactive Brokers studio. Welcome back. It's good to see you. It's been a while.
Great to see you too. Thanks so much, Carol and Tim.
How is the environment right now? Because the president has been on this lower the rates, lower the rates, lower this rates train for months. Is that preventing you from actually doing any multifamily building?
Yes, in so much as the industry as a whole has been white knuckling, I would say, with an expectation of rates coming down. They've been white-knuckling the sale of assets. We're primarily in the secondary market rather than developing, specifically in multifamily. So,
but you still have to do a lot of work to those multifamily.
Absolutely,
homes.
we're doing massive renovations, and so inflationary costs around that are material, etc. But yes, the rates environment has had a tremendous effect on the multifamily market, and until rates come significantly lower or sellers reprice in a material way, then it's tough for the market to get started again.
That's what I wanted to ask you. If we just know, all right, the Fed's on hold because this is what's the policy that makes sense for the next 6 to 12 months, then folks are going to do deals, right? It's like having some clarity, because historically we're still at a lower rate environment. We've had much higher rates. And I guess my point is, are people just looking for clarity on what the policy is? And there's just, between the back and forth between the White House and pressure on Fed Chair Jay Powell, and maybe folks thinking that that could ultimately lead to lower rates. I mean, that uncertainty, essentially, and at the same time, tariffs, which are putting another layer of uncertainty. So the Fed doesn't know exactly what the environment's going to be, so they're on hold. So if at some point we have more clarity and the Fed says, nope, economy growing, we're doing good, Thomas, that then people will say, well, this is the environment, so we'll reprice and we can do stuff and we'll move ahead. Sorry, that was a long way of saying clarity.
Yes, indeed. Clarity would be extremely helpful, and perhaps you would have some owners be willing to transact again. However, a lot of owners still, asset holders still have 2021 and peak pricing in mind. And so it's hard to let go. It's hard to reprice an asset lower, especially an income-generating asset.
Right.
So because they're income-generating, you can hold on to them far, far, far longer than you would be able to otherwise, even if pricing theoretically should be lower if you were to sell, but you don't sell. You just hold on to it for years longer. But yes, hopefully greater clarity would be useful, but I would not say we're in a particularly clear environment right now.
No.
So clarity's not there. And so volumes in terms of secondary market volume for commercial real estate in general is substantially lower than it was at the peak.
So what are you doing? Are you not buying anything right now?
So we are not buying a lot right now, no. The only deals that we're doing are situations where the seller is genuinely in distress. So if there's not outright distress, it's very, very hard to make the numbers pencil. And what we're focusing on instead is actually where the big, beautiful bill has created a short-term window of opportunity, which is solar development, interestingly enough.
This is what I'm glad we're talking about this. It was in the notes, and our producer Ari said this on the phone, and I was thinking to myself, solar?
Yeah.
Because the concern, and we saw this play out in the public markets, was that solar companies would get hit hard as a result of this bill, and they've been under a lot of pressure. Where are you seeing opportunity?
They have been hit hard, and there is really very limited window for opportunity. So it's not great if you're full-time in that business, but for us, we're a private credit lender to solar developers that might have a 20 or 30 development pipeline of projects, and it enables us as a lender to step in on a senior secured basis and identify and cherry pick really the best, most actionable, immediately actionable projects where we can get shovel in the ground right now and bring these projects to fruition, because very shortly any investment tax credits are going to disappear. So it is about a short-term window, and for us the opportunity is as a lender. Absolutely, this bill has been extremely problematic for the development industry and for generation of solar power in the United States.
How short-term, and what are the terms looking like?
So we need shovels in the ground this year or by the middle of next year if there is no foreign content. And we need completion of the project by the end of 2027. Some of the rules are still to be finalized, actually. The Big Beautiful Bill obviously passed on the 4th of July, but a week later, the Trump administration issued an executive order that the IRS has 45 days to clarify the rules. So interestingly enough, we're playing by a rule book that we don't fully have the details for.
You talked about lack of clarity.
Correct, lack of clarity.
It hits a lot of different areas.
That's right. But there is opportunity there in the short to medium term for us to help those small to medium-sized developers bring those rapidly deployable projects where we can get energy to the grid before the end of 2027, online immediately. But they need capital. and they're very profitable when you do it. And that's where we see the short-term opportunity in development.
Then do these projects go poof?
Well, no, the project will last for 20,
But I mean new
25,
projects,
et cetera. But
that's it.
if you have a 30 project pipeline, you might have 5 that you can bring to fruition, you might have 25 that go poof.
All because of tax credits.
Correct. Now, there will be major changes that are going to occur.
Yeah.
The cost of construction for solar projects, the EPC construction costs are highly likely over time to come down because if there's less development going on, those construction companies will reduce their costs. So there'll be opportunities there. There will also be opportunities for states that want to continue to incentivize solar to step in and provide credits where the federal government steps out. And then finally, the utilities themselves, which at the moment use the interconnection fee and other aspects of solar development to make money, they will probably compress their margins as well. So there are a number of different moving levers, and then ultimately the cost of electricity is going to go up.
Well,
and that's going to be a huge driver of value.
This is what I wanted to ask you. What are the projects that you are investing in?
So the projects that we're lending money to are...
Or lending to, forgive me.
Exactly. For clarity, we're a private credit fund that lends money rather than investing equity.
Right.
But those projects are below utility grade. They're what are called community solar. So they're usually in the 5 to 50 megawatt project size, whereas community solar really kicks, utility grade solar kicks in above about 100 megawatts. Those projects, because they are much more challenging and time consuming to execute, a lot of those have gone, to use your words, poof, because they can't be delivered in that time frame. So there is a massive change in the demand, as we know, for solar as a result of AI and for electricity in general. But now there's a material change in supply for the negative.
Before we let you go, back to your focus on multifamily. In the past, you've been on with us and you've spoken excitedly about the Sun Belt. Where geographically are you thinking for opportunity now?
We continue to see a lot of opportunity in small to medium-sized cities across the Southeast, the Carolinas, Georgia, where these right-to-work states, where we're seeing a lot of new battery factories and other new factories being built. It's those small to medium-sized markets where we continue to see a growth in demand, an increase in wages, an increase in job opportunities, and we're there to do our best to support that with housing.
How would you describe the economy? Just real quickly, 20 seconds. The
Pretty
U.S. economy?
strong jobs market, but a lot of lack of clarity around issues such as tariffs and rates that that make it challenging for long-term deployment of capital.
All right, interesting. So it sounds like potentially a lot of stuff sitting on the sidelines, just waiting for some clarity.
That, certainly.
All right, good to check in with you. Thank you for coming in.
Thank you.
Yeah, appreciate it. Thomas Carroll, he's founder and chief executive officer of Ballast Rock Asset Management, joining us right here in our Bloomberg Interactive Broker studio. Folks, we're looking at a market that's been bouncing around near our highs, though, on the S&P. Could be another record close. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. 20 minutes to go ahead of the closing bell. We have got the S&P 500 index trading at a record, just about the best level of the day right now. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks trading mixed in a quiet tape right now. Dow's currently up 174 points. S&Ps are higher by 7, but NASDAQ is lower by 94. The U.S. 10 yield is at 4.34%. Gold is in the green, oil is in the red, but Bitcoin, that's higher by 2.1%. Leaders in the upside in the Dow, Amgen and Merck, while NVIDIA fell 2% and led to the downside. Among the main 11 S&P sectors, leaders were healthcare and real estate. Tech was under pressure. After earnings, D.R. Horton jumped 16%, while Philip Morris dropped 8%. In other news, Microsoft accused Chinese hackers of exploiting SharePoint. And wrapping things up, Capital One and Texas Instruments report after the bell. Live on the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type SQUAWK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the drive to the close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. About 18 minutes to go until we wrap up the trade on this Tuesday, July 22nd. Carol Massar, Tim Stenovic here in our Bloomberg Interactive Brokers studio. Looking at probably another record for the S&P 500 if we continue at this level. 63.14, up about just shy of 9 points, 192 points higher on the Dow Jones Industrial Average. We've seen big tech under some pressure today ahead of big tech earnings getting underway. We'll get a couple of big ones tomorrow after the close. NASDAQ 100, Tim, right now down about 92 points off our best and worst levels of the session.
Let's see what Leo Kelly has to say about all this. He's founder and CEO of Verdance Capital Advisors. More than $4 billion in assets under management. He joins us from Hunt Valley, Maryland this afternoon. We're in a kind of a weird place, I think, and I think Carol agrees with me here.
We're feeling kind of weird.
We're feeling a little weird because
just going to tell you,
we got the crypto market doing its thing, $4 trillion in assets as of last week. Bitcoin around a record, new record, close to $120,000 per Bitcoin. The meme stocks are memeing.
They're memeing.
It's a little crazy.
Yeah.
Yet tariffs are on the horizon here, and those are going to hit on August 1st unless something changes. What am I missing here?
Well, you're not missing that. It's weird. It is. And it has been really for a few months, right? So April 2nd comes along, and we have the tariff tantrum, which was shocking in of itself. I mean, imagine for a minute being surprised that Donald Trump is going to pull a hard line to negotiate with. That should be expected, not be surprised by it. And so we have this dramatic impact in the market, which is immediately turns around and we make new highs. I think the tariff thing gets done. What I think people have to do is take a step back and ask the question, what's important right now? What is it we should really be focused on? Should we be focused on whether the tariffs are 15% or 20%, or just that they're going to get done, and they will get done? Should we be focused on whether or not Jerome Powell is the next Fed president, or whether or not rates are going higher or lower? And if they go lower, will that stimulate inflation? We think it will. And in the intermediate term, are we bullish or bearish? Well, we're actually pretty bullish. There's a lot of investment coming to the U.S. We have earnings are starting to gain a little momentum. AI productivity is going to be significant. So there's reasons in the intermediate term to be bullish, and there's a lot of volatility, I think, headed in front of us in the fall. So yeah, it's weird because it feels a little scary in the very short run, and yet there's so many reasons to be bullish in the intermediate term.
All right, I just got to take a step back because I think last time you were on with us, Leo, was in mid-February. Yes. So what a long, strange trip it's been for U.S. stocks. So I'm just curious, you kind of walked us through some of this stuff, right, in terms of the imposition of tariffs by President Trump and backing off. What has the last 5 months been like for you and managing money for your clients?
Been interesting. So we've been holding cash in lieu of long bonds. So we've had cash. We have been extremely disciplined in rebalancing portfolios and not letting the hot stuff go too far and get too far out of kilter. So we had some dry powder, and to be fair, over the last couple of years, we've been waiting on volatility to put money to work. So when April hit and we had this volatility and this pullback, we were very active in that moment. And so for us, this year has been active. It's been active from the standpoint of executing when the volatility has hit and then maintaining discipline as we go through this. And we're continuing to tell clients that more volatility is coming, but we're a little more bullish than we've been in years past. In years past, we've been a little hesitant to jump into the volatile moments. We're not anymore. We're buying into volatility because we do think the intermediate term looks pretty good.
Well, volatility, that was certainly something that we saw in April, but things have been really calm over the past few weeks. What opportunities have you seen of late, or are you still sitting on the sidelines waiting for things to move lower?
Well, I would say this. There's a couple of things that are going on over the last several weeks. One, valuations are starting to get stretched again, especially in the hot stocks, right? The big tech stocks. And so I think if the market continues to move higher at this pace, our next move would be to reduce again, because our allocations will get out of sync. But there's still areas in the market to invest. Small mid-cap stocks still look pretty reasonable. International stocks made a big move. You might recall here last year, we were big proponents of international stocks. We were a bit overweight. They've made a big run this year, so we're a little out of, out of allocation on that as well. And in the private markets, there's still a lot of opportunity in private equity investing, private credit. There's some interesting energy plays out there. So we're always active in the markets, just not always in the S&P 500.
Well, that's what I was going to ask. I mean, increasingly everybody's been talking about the private markets. And so, for folks who focus on the public markets, you do wonder what you're missing, or you probably know what you're missing. Increasingly, are you, for your client base, Leo, more interested in the private markets, that's where you can kind of really juice performance versus the public markets?
Well, we have been for a long time. So we've been long-time players in the private markets, and we continue to put a lot of focus around that. I think there's some caution that we have to warn folks about when they start looking at the private markets. This democratizing private investments, especially with the new law that was just passed that allows these private investments to go into 401ks and IRA accounts. There's going to be folks chasing return. And private investing is great if you do a few things. One, you have rigorous due diligence. That's really important. Two, you have to diversify the portfolio over vintage and style. Too many times people get excited about one or two hot dots and they sound great and they have great past performance returns and they'll throw a lot of money. Well, in the private equity world, that could be very dangerous because it's illiquid and you get stuck for a long, long time. It's not like a stock market that goes down and then pops right back up and you can wait it out. With the private markets, you can be sitting on that for a long time. So I think folks have to be aware of the illiquid nature of it. So you have to allocate correctly, not just how much you put in private markets, but per deal and per vintage, meaning what year you're buying into. It takes, Carol, it takes 5 to 7 years to build a good private equity portfolio. So it's just not something you can just jump in and do.
No, I totally understand. And I mean, we've talked a lot about private equity, the difficulty in kind of getting out in the last few years. Right. So people are trying to figure out their portfolio. We got to run. Leo, good to talk with you again. Be well. We'll talk soon.
Always good to be with you guys. Thank you.
All right, Leo Kelly, he's founder and CEO of Verdance Capital Advisors. They've got about $4 billion in assets under management. Joining us once again from Maryland. Hey, folks, we're coming up on about 11 minutes to go until we wrap up trade on this Tuesday.
The vast majority of stocks in the S&P 500 are higher. 409 stocks higher, 93 lower at this point. Though it was kind of easy for me to find decliners, I'll be honest.
It was, wasn't it?
Yeah, but under the surface, under the surface, things are moving higher. But on the surface, Carol, we're seeing really muted moves.
Was there a lot of Mag 7 in there?
I don't know.
Oh, okay. Whoa, these teas. He's not going to tell us.
It's a tease, guys. It's a tease. We don't have time.
Did not go anywhere. We're going to head over to our TV colleagues in just a moment. We're going to count you down to the close in just a sec. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we are just about 7 minutes away from the close on this Tuesday. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Broker studio. As we mentioned, just up about 6 points on the S&P 500. If so, any gain today would mean another record on the S&P. Dow is up about 188 points. We continue to remind you that we have seen pressure on some of those big tech names as we get ready for big tech earnings this week. So we're down about 92 points on the NASDAQ 100, so some underperformance there. But we've been seeing some volatility. Remind everybody that we're still early when it comes to earnings season. We have some big names to report, including Tesla. That's tomorrow.
That's tomorrow. So is Alphabet.
Yeah, big ones. So we'll see what we get out of those guys.
You want to talk about trains?
Trains, planes, and automobiles?
This time it's just trains, but you got to take a plane to get to the train if you're in New York.
Do I not worry? What's going on?
So it's one of the most read stories on the Bloomberg terminal. It's about the Brightline train that runs from Miami to Orlando. It's been lauded as an alternative vision for the future of American rail travel. It's actually making some investors a little anxious.
What's going on?
The concerns have amped up since Bloomberg reported earlier this month that Brightline was going to delay an interest payment on $1.2 billion of bonds it issued through the municipal bond market. It's one of several different types of debt issued by various arms of the company. Brightline's ridership and revenue have lagged projections. It's created a growing number of financial hurdles for Fortress Investment Group-backed project, and it's defied enthusiasm about the train that was shared by Ron DeSantis and Joe Biden.
Yeah, it's interesting. The story talks about how investors who have and are holding the company's $5.5 billion in outstanding debt, they've been apparently bouncing between Brightline calls and meetings as they are trying to figure out and understand the extent of the stress that the company's under. This is according to someone or two people familiar with the matter who asked not to be identified because those conversations are private. But the prices of its junk bonds are plummeting, and so some holders of the company's corporate bonds have had some conversations with law firms about their options as the company's looking to raise some new equity and debt and comes under pressure to roll over a $985 million tax-exempt note in August, again, according to those people who are familiar.
The conversations are all preliminary. They point to problems at what has been hailed as the first privately funded U.S. railroad in more than a century, and one that was seen as an alternative to the struggles of Amtrak and the blunders of California's high-speed rail project. Here's what Ron DeSantis said earlier this month during an appearance with President Donald Trump. Quote, "We've got a private-funded rail in Florida from Miami to Orlando that cost the taxpayers zero, and it's very successful."
You know, it's really interesting because we have a light rail where I live that was put in, I don't know, a bunch of years ago. And I don't know that there's that much in terms of ridership.
Where does it go? Just around the city?
It goes kind of on the Jersey side of the Hudson River, just across from Lower Manhattan. It goes, I'm trying to think where it goes from.
But this is not the,
all along.
This is not the path. This is separate from the path, just in Jersey City and Hoboken.
It goes up to, gosh, how far does it go? Weehawken, or like it goes up and down. I think it goes to Bayonne and so on and so forth.
That's pretty cool.
So it is. And I mean, if you
Sounds
think.
fun, actually, to ride.
It is kind of, I've done it.
Yeah.
To see the fireworks on the Jersey side. But I just, you know, it's really funny. I feel like in the U.S. are in such a society that is
automobile dependent?
Yeah. Not that it's anti-train, but I would love to see some of the train systems built out here in the United States.
Yeah, it's been a dream for transit advocates for many, many years, and it's run into many, many issues, namely California's high-speed rail that really for over a decade has just been costing a lot of money and running over projections in a really significant way, to the extent that it's become a real political hot button issue, not just for Gavin Newsom, but also for President Trump.
Yeah, and I think this was also part of, you know, some big redevelopment around the Miami port and so on and so forth. They've been doing a lot of stuff there in terms of infrastructure and moving people around and moving stuff around. So we'll see what happens with this and how it plays out. But nonetheless, right now, you know, it definitely has some of the debt investors a little nervous, it seems like. All right. Do not go anywhere. We've got some earnings after the closing bell. We've also going to just kind of take a look at some of the winners and losers in today's trade. Stick around. The closing bell. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day on this Tuesday. Scarlett Fu and Katie Greifeld here with you to take you through the closing bell. We've got a global simulcast. We're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide as we parse through the most crucial moments of this trading day. And Carol, I feel like the crucial moments are we're waiting until Wednesday when two big cap tech names report.
I think you've said it so well. I mean, we've been bouncing around here, and we've got kind of little changes on both the S&P, some big tech under pressure. Want some outperformance, folks, though? Look at the home builders. That as a whole up about 10% if you look at the S&P Composite 1500 home building index. And, you know, that has D.R. Horton and Pulte to thank because some of their numbers coming in and beating Wall Street expectations.
A couple of those would be good gainers. I don't know what you have on tap, Carol, but those are a couple of good ones if it's not too late. You know, I'm thinking we got Coca-Cola, we got Lockheed Martin, we got General Motors, but like Scarlett said, we haven't gotten the big ones yet. We are starting to see a picture emerge, though, of what companies are dealing with when it comes to tariffs and what they're thinking about when it comes to the American consumer. And I guess it turns out, Katie, we want sugar in our Coca-Cola.
Yeah, surprise, specifically U.S. cane sugar, apparently. And we were talking about it, how it's really a political statement, but that kind of feels like what companies have to do in this environment.
Yeah, that's kind of appropriate for the moment in any case. As we look at this market, there's this resilience to equities that it kind of surprises me time and again, even with all the uncertainty regarding trade policy, tariffs, and even the fate of the Federal Reserve Chair. There you have the closing bells. We are looking at record highs here for the S&P 500, even as it's given up a little bit of its rally here towards the end. Looks like it's going to close up about 0.1%, finishing above 63.10, maybe, almost.
There you go. Well,
almost there.
Not quite.
Not quite. All right. The NASDAQ down about 0.4%. The weak link there is some of those big cap tech names before Alphabet and Tesla report on Wednesday. And Dow Jones Industrial Average adding 0.4% to 44,502. And the Russell 2000, actually the outperformer of the day. And Katie, you and I were talking about this. We've seen the small caps kind of get a little bit of a tailwind the last month or so, but for so long, they've been perennial laggards when you compare them to big caps over the longer term, anything past 6 months.
Just like Europe, which is amazing. But at least for today, small caps in the sun, Carol Masser.
All right, Katie Greifeld, S&P 500, back to the big caps we go. And man, do I have this right? Because I feel like the split has been all over the place, but we're ending with about 407 names to the upside in the S&P 500. Katie, just 95 to the downside.
No, you're right that
It wasn't like that before.
Exactly.
A little while ago.
We have really good breadth today, even though you wouldn't necessarily know it by looking at the percent change on the S&P 500. But when it comes to the sector change today, you had 9 of 11 sectors in the green, led by healthcare, actually, on a points basis. But it was big tech on the downside.
Well, speaking of big tech, we have a smaller big company from the tech space reporting. Texas Instruments coming out with second quarter EPS of $1.41, beating the consensus estimate of $1.35. Revenue for the quarter was $4.45 billion, also higher than anticipated, which was $4.36 billion. As for the outlook, it sees revenue for this quarter between $4.45 billion to $4.80 billion. Analysts were looking for $4.57 billion, so the midpoint of that range handily beating the consensus estimate. Third quarter EPS will be anywhere from $1.36 to $1.60. Analysts were looking for $1.50. And second quarter CapEx, now I'm going backwards here, was $1.31 billion, more than expected. Analysts were looking for $1.17 billion. And you can see right now the stock, Tim, down about 7% in after-hours trading.
Yeah, there's no commentary from executives in the press release. Going to have to wait to get that from the earnings call, but worth reiterating that revenue increased 9% sequentially. It was led by continued brand recovery in industrial, 16% from the same quarter a year ago. The company also saying that over the past 12 months, they've invested $3.9 billion in R&D and SG&A and invested $4.9 billion in CapEx and returned $6.7 billion to owners.
All right, so just a reminder here, folks, you are seeing a lot of selling in Texas Instruments in the aftermarket, down about 8%. There was some concern and nervousness heading into this report because they felt like the outlook, a lack of visibility, and any obvious growth catalyst might put some pressure on this name, but it's the street not liking it. And you got to keep in mind the stock is up about 15% year to date, but definitely some disappointment here in the aftermarket, Katie.
Yeah, that outperformance might be a reason why you're seeing this after hours reaction right now, which looks pretty dramatic. Like you said, down 8%. Now, of course, their third quarter outlook didn't include changes to U.S. tax legislation, so maybe that explains some of the negativity here. But we've been talking all program about how a lot of these companies, the bar is really high, at least when it comes to sentiment, and these misses, if there's anything to pick at, are getting punished, Carol.
Yeah, and I would say, I just want to throw one more thing in, and maybe the disappointment has to do with the third quarter outlook, right? It's seeing third quarter EPS of $1.36 to $1.60. The estimate is $1.50. It sees third quarter revenue from $4.45 billion to $4.8 billion. The estimate is $4.57 billion. So there's a bit of a range and definitely some room for disappointment. So maybe that has to do with some of the selling that we're seeing here in the aftermarket. We'll keep a watch on it, but right now shares of Texas Instruments still down about 7%. Hey, just a quick summary of some of the stocks that were on the move in the regular session. We talked about home builders, outperformance there. Here's the reasons why. D.R. Horton was up about 16% here at the close today, a top gainer in the S&P. The third quarter earnings beat expectations. Profit orders and home closings beating analyst estimates. Go to PulteGroup, also out with their results. That stock was up 12% at the close. Again, a top gainer in the S&P. They reported better than expected earnings. So that was a big one. And we got some more earnings crossing.
Yeah, looking at Intuitive Surgical, pulling it up on the Bloomberg terminal, seeing shares in the after hours, not necessarily on the move. Intuitive Surgical second quarter revenue coming in at $2.44 billion. Estimates were for $2.35 billion. Second quarter adjusted earnings per share coming in at way above estimates at $2.2 billion. The estimate was for $1.93. Shares now on the move, higher by 5.7%.
Yeah, starting to see some reaction there after second quarter adjusted EPS beat its estimates. And this is a name that needed some good news, Tim. You consider the fact that Intuitive Surgical shares were down about 2% heading into today's close in these numbers.
All right, we have most of the big banks done reporting, but we have a financial company that has just reported, and that is Capital One. Let's give you the second quarter adjusted EPS number, $5.48, far away beating the consensus estimate of $3.88. So maybe we're not comparing like with like. Let's look at the net revenue line, $12.49 billion, also higher than the expected $11.84 billion. Net interest margin for the period was 7.62%, better than the 7.43%. As for loans held for investment, that came out to about $439.3 billion. Analysts were looking for about $397 billion. And one comment from Capital One, the integration of Discover is going well. So we're looking for more commentary, of course, on that. Second quarter provision for credit losses was about $11.43 billion. The consensus estimate, if this is the right comparison, is $3.88 billion. That seems a little bit off, but we'll dig into that a little bit more. The stock is now lower in after-hours trading.
All right, here's one that is definitely rallying in the aftermarket, although it's having a pretty miserable 2025. We're talking about Enphase Energy. It's up almost 6% here in the aftermarket. Keep in mind, it's off about 37% year to date, the solar energy company. And let's go through some of the numbers. Second quarter adjusted EPS, that's a beat, 6 cents better than what the street was expecting, 69 versus the estimate of 63. Second quarter revenue, that came in better than forecast, $363.2 million. The estimate was $359.3, and then this is what matters, perhaps. The third quarter revenue outlook, $330 million to $370 million. It's quite a gap. The estimate is for $371.9 million. But again, this stock, Katie, is up about 8% in the aftermarket.
Yeah, it's wild. Well, you mentioned that it's having a miserable 2025, so just to put some context to that, shares down about 38% on a total return basis into the close. We know that Enphase and some of the other clean energies, some of the other solar names have been really whipsawed by policy coming out of the White House. So I guess the fact that they were able to report good news on any level, you can see the shares really taking off after hours.
Yeah, speaking of whipsawing, I'm watching shares of Intuitive Surgical. At first, they did move higher. Now they're down 4.5% in the after hours. The company did say, remember, this is the company that has the Da Vinci surgical robot. It's that high-precision robot that does surgery on many different parts of the human body. They did say that procedures grew at approximately 17% in the second quarter of 2024. And now they grew their Da Vinci surgical system installed base to 10,488 systems as of the end of the quarter in June 2025. That's an increase of 14% compared to June 30th, 2024.
And just real quickly, analog devices and on-semi both down in sympathy, I guess, with Texas Instruments, which is still down about 6.8%. So we're seeing some impact on some of the other chip names. All right, guys, that's a wrap across platform, radio, TV, YouTube, Bloomberg Originals. We do it all across all of our platforms. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, Tim and I back on Bloomberg Business Week Daily. He's making sense because I was like, but that's because there's a bunch of earnings and we're just trying to keep track of them all.
I got to be honest with you, I did not have enough windows open for all the companies that were reporting.
I'm like closing things down. We should point out Texas Instruments, it's down about 6.5% here in the aftermarket. So on semis also down about 3.9%. Analog devices right now unchanged, initially taking a bit of a hit. But this is after the company came out with their outlook. Sees third quarter revenue $4.45 billion to $4.8 billion. The estimate is $4.57 billion. So a little bit of a range and the opportunity that they could actually miss what the street's looking for. But they also could outperform. So we'll look for some more color on that call with analysts and investors.
Enphase Energy, which is down 38% so far this year, Carol, they're reporting results. It's up in the after hours by about 3.7%. The company said second quarter total batteries shipped was 190.9 MWH, beating an estimate of 164.34. Second quarter microinverter units shipped came in below estimates at 1.53 million. Second quarter adjusted EPS, though, came in above estimates at 69 cents. The company, as far as that outlook goes, sees third quarter revenue $330 to $370 million. The estimate was for $371 million, but I guess expectations were low since the stock's been down and beat up so much this year.
Yeah, it's really been beaten up in a big way. We mentioned Intuitive Surgical also out in the aftermarket, and that one is down only now about 1.4%. It's bounced around a little bit here in the aftermarket, but we've seen it trending lower on the latest check here. It initially jumped about 6% on that earnings beat, but I'm looking at now the stock, like I said, bouncing around. It sees 2025 adjusted gross profit margin of 66 to 67% of revenue, sees the fiscal year Da Vinci procedure growth of about 15.5 to 17%. And I was just trying to look to see if I had some estimates in terms. Let's just see, because there was expectations that the Da Vinci, some of the gains there would counter some of the tariff uncertainties, at least according to our Bloomberg intelligence team. But again, we're seeing this stock some wild swings here in the aftermarket.
You know they did surgery on a grape?
Recently?
No, but that's like the meme.
Oh.
A few years ago. And there's this whole meme about doing to show how precise this tool is.
A grape is pretty small and a slippery sucker.
They peeled the skin of a grape using this robotic tool. Yeah. I have a friend who does head and neck cancer surgery. He uses this thing all the time.
So what does he do? Just watch?
No. He's got to use his hands.
Oh, he guides. Okay.
I've never mind you, I've never been in the operating room. to see this happen. But
Glad
they can do it.
Glad to hear that.
Well, but as a patient, but also as, so I know they use it for head and neck surgery. I know they use it for prostate procedures as well.
Right.
This thing's used all over.
Yeah, no, I know it's
all
pretty
over the
popular.
U.S., all over the world, too.
Yeah, so pretty wild, right?
Yeah.
I mean, in terms of the use. I'm just looking for any more headlines here. Again, it's down about 1.3%. That's Intuitive Surgical. We mentioned Texas Instruments, which continues to trade lower here in the aftermarket, down about 8%. You mentioned Enphase Energy. Again, that one, which has been really beaten up here in 2025. Right now, Tim, up about 1.2%. Some big swings, though, here in the aftermarket.
Remember, the things we're watching as far as looking ahead is tomorrow and Tesla in the after hours, because that is a company that is going to report at the close of trading. Don't forget, Carol, that when Tesla reports, they kind of do it in this confusing way where you have to open up the presentation and look closely at the slides with the presentation to get the numbers. So expect a little bit of delay there. And then also we have Alphabet reporting too.
All right, so we'll look forward to that. In the meantime, a lot of talk about pressure on the Fed Chair, Jay Powell. Right now, our team over on the television side, Katie Greifeld and Scarlett Fu, talking with Michael Falkender. He's Deputy Treasury Secretary. Let's listen in.
Recognizing the inherently inflationary impact of the Biden administration's economic policy, they waited too long to start raising interest rates to offset some of the inflationary pressure that it was going to create, and then juxtapose that to now, where we're putting in place supply side benefits to the economy through the president's signing of the One Big Beautiful Bill a couple of weeks ago. All of the deregulatory activity we're engaged in. We see the inflation numbers coming in below expectations, and yet, as the president said, we have not seen the Fed come in and commensurately cut rates, and now we've got one of the highest interest rates compared to our peer nations. So he was too late to raise rates when the Biden administration's economic policies were inherently inflationary, and he's been too slow to cut rates now that we are putting in place supply-side economic policies that should be bringing down price pressures.
And of course, Scott Bessent, the Treasury Secretary, has weighed in as well, saying that there's nothing he sees that indicates Jay Powell should step down right now. But he also added that if Powell wants to see that through, he wants to see through his term, he should be able to do that. And if he wants to leave, he should as well. How do you interpret that? I had trouble understanding what he was saying there.
I mean, ultimately, it is the decision of the Federal Reserve Chairman as to whether or not he steps down or not. But I think the most important thing that the Secretary called for is that the Fed really should undertake a review of its practices. So it engages regularly in a monetary policy review, but the Fed's mission creep has extended beyond monetary policy, and there has not been a review of the extent to which they have succeeded or failed at some of the other activities that they are responsible for. And so if you look at the bank failures that we had over the last couple of years, where was the Fed in terms of its supervisory activity? We have got this building that's being built, and we've got thousands of economists over there, and it's questionable what service the American people is realizing from them. And so I think what the Secretary has come out and said is that there are 8 months left in his chairmanship. If he wants to serve it out, the president has said he can do so, but that does not absolve the chairman from doing a full review of what has happened under his watch to make sure that we're reviewing whether the Fed is appropriately stewarding their portion of this economy.
Well, let's talk just firmly about monetary policy and what you believe should happen there, because I believe just today alone, President Donald Trump said that he thinks that interest rates should be at 1%. You take a look at the effective Fed fund rate right now, it's at 4.33%. So that would certainly be a dramatic move. And when you take a look at the state of this economy, where we stand, I mean, do you think, in your opinion, does 1% look reasonable from where you're sitting?
When I look at the data out there and the progress that this administration is making to relax any inflationary pressures, it seems like the interest rate environment that the Fed has should be reevaluated and come down significantly. Now, again, I'm not going to say, I'm not a member of the Federal Reserve, so I'm not going to say where interest rates ought to be. But if you look at the data, inflation is coming in below expectations. We recently hit a 4-year low on inflation. We're putting in place certainty on taxes. We are deregulating the economy. We are signing great trade deals. We had 2 of them announced today. And so the president's full implementation of the president's economic plan is inherently disinflationary, and yet the Fed keeps rates at the high levels that they're at. Arguably, there is enormous room for the Fed to come in and cut rates.
Well, we have that next Fed meeting coming up just 8 days from now, next Wednesday. I don't think the market is anticipating a rate cut there, but crazier things have happened. I do want to talk a little bit about trade because Treasury Secretary Bessent, of course, is meeting his Chinese counterparts in Sweden next week. What are the expectations for those talks? What would you expect to be discussed there?
I anticipate that the Secretary is going to continue to make progress on the terms of a final deal. So there is continuing discussion about access to markets, about opening up the Chinese markets, issues associated with their activities on rare earths and the export controls that they have put in, and of course also the ultimate tariff rate. So there is enormous space for us to talk about what for decades has been practices by the Chinese government that give them unfair advantages in the global marketplace, and that this president in his first term said that we are going to finally address, and I anticipate that the Secretary is going to make significant progress when he meets with his counterpart next week in order to have discussions about getting towards a final deal.
The Treasury Secretary also said that the discussion may broaden out to Chinese purchases of Russian and Iranian oil as well. What sense do you have that Beijing is ready to discuss those issues with Washington?
I mean, as you know, the president has said that the war in Ukraine never should have started, that we need to put pressure on the Russians in order to bring an end to that. And that means upping our pressure, using our sanctions authority and our conversations with our international partners to reduce the flow of funds that are going into Russia. Simultaneously, we are still looking for the Iranians to curtail and end their nuclear weapons program. And in that case, we are going to continue applying maximum pressure on them. And in both cases, it largely is China that is purchasing sanctioned oil from the Iranians and the Russians. And so we are continuing to ask the Chinese to do their part to see that those countries not be able to fund their aggression through these oil sales that the Chinese are purchasing.
And what is the worry that if you press Beijing too hard, that China will begin withholding exports of those rare earth magnets and other crucial raw materials as they've done in the past? They could slow walk it again, because that's a big issue and it's finally starting to come through again.
I think what the Secretary is going to do is just have a comprehensive discussion about all of these issues and identify where we can strike the right balance with China in order to, again, address this persistent trade deficit and also elicit their cooperation in addressing some of these geopolitical conflicts with Russia and with Iran.
I do want to talk about a social media post that came from Treasury Secretary Bessent earlier, talking about this CapEx comeback that the administration sees underway. And I thought it was an interesting time for that tweet or post on social media, rather, given that we are really entering the thick of earnings season. So according to your data, I mean, you take a look at this gain that we're seeing in the first quarter, as you say, strongest back-to-back growth since 1997. But you take a look at some of the commentary that is coming out of these earnings calls, and there's still a lot of uncertainty out there. You think about companies trying to plan for CapEx, trying to plan for headcount investments and the like, and it's hard to make policy and make decisions when the tariff stance can change week to week or sometimes day to day. And I just wonder if you're hearing any of that feedback when you have conversations with corporations.
So again, when we look at the data, we see that investments in capital equipment are increasing significantly, and we attribute that to the fact that we just provided enormous tax incentives to engage in new capital investments. So whether it's taking equipment expensing back up to 100%, or it's taking new factory purchases likewise to 100% expensing for the next 4 years, both of those are going to stimulate investment, whether it's R&D tax credits, whether it's the deregulatory activity we're engaged in. If you think about the fundamental shift we took in artificial intelligence, in digital assets, in energy, all of these things are inherently pro-domestic production, and that's why we're seeing this enormous response by businesses in increasing their capital investment well above where it had previously been, and as you said, hitting levels in growth not seen since 1997. So every day we are resolving some of these ongoing decades-long trade issues, but at the same time we're creating enormous incentives for domestic investment because of the deregulatory and tax agenda that this president has led.
What is your confidence that that CapEx is going to lead to reshoring manufacturing in the U.S. with jobs for people as opposed to reshoring manufacturing using robots?
So whether we reshore, we are anticipating that whether the job creation is going to come from the building of the factories, the building of the equipment, and those factories are still going to need people inside them. And so, if you're bringing back a manufacturing activity from abroad and you're bringing it to the United States, irrespective of how much of that manufacturing is done by robots and automation versus how much of it is done by people, there are still incremental people that are being employed, and there is incremental economic activity that is occurring that is to the benefit of the American people. So we are looking forward to generating an enormous renaissance in capital investment and the industrial base here in the United States. And we do recognize that through artificial intelligence, through automation, there is enormous opportunity for productivity gains, and that the skilled labor that is going to be employed in these facilities is going to be high-wage opportunities for everyday Americans.
Well, we really appreciate you making the time for us. We know it's hot out there. That is Michael Falkender. He is Deputy Treasury Secretary. Really interesting conversations.
There you have it, Michael Falkender, Deputy Treasury Secretary, joining Bloomberg's Scarlett Fu and Katie Greifeld just a little earlier. Actually, just now. That was live.
That was
by a little earlier, I mean just now.
It's one of those kind of days, folks. Just bear with us. Bear with us. All right, let's
Time is a flat circle.
let's get a check on some of the earnings after the closing bell. Your top business stories. Once again, he's always on it. Always knows whether it's live or not. Charlie Pellet for Bloomberg News Flash.
Definitely live, definitely here, definitely now, and I've got you covered after hours. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses, Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Keeping an eye on Texas Instruments, the stock declining, late trading after giving a revenue forecast that fell short of the most bullish estimates. After hours, right now, we have got shares of Texas Instruments trading down by 7%. The other closely watched report after the close of trading, Capital One, it reported adjusted EPS for the second quarter that beat the average analyst estimate. Capital One after hours up by roughly 1.5%. Another day, another record for the S&P 500 index, closing 6309, up 4, little change, but still higher, and that means a record up 0.1%. The Dow up 179, up 0.4, a retreat today for NASDAQ, down 0.4%. 10-year 4.34%, the 2-year 3.83%, gold up $33 the ounce, up by 1%, and West Texas Intermediate crude down 1.5%, 66.21 for West Texas Intermediate crude. So recapping, Texas Instruments down 7% after hours, S&P at a record up 4, up by about 0.1%. We're live, we're now. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. I want to bring in Bloomberg News Senior Editor for Technology and Strategic Industries, Michael Shepard. He's been a busy guy lately. Not only does he cover everything happening when it comes to semiconductors and chips with regard to the U.S. and China export restrictions, but also the way that different countries seem to be buying or announcing they're buying airplanes as trade negotiations are ongoing. The latest, the president saying that Indonesia will buy Boeing planes, also agriculture and energy. Michael Shepard joins us from Washington, D.C. He's Senior Editor for Tech and Strategic Industries. To what extent are strategic industries part of trade negotiations with this administration?
They're a core to it, Tim. You can really see it in so many different ways. And the purchases, or the promises to purchase at least, those planes from Boeing really signals that the administration wants to make sure that American products are being bought and used by American trading partners abroad. And that includes economies as large as Indonesia's. And they want to make sure that those products from Boeing take precedence over whatever may come from the European Union or China. But we also see, even with China, that the U.S. is introducing some of these strategic goods in the negotiation process, and it is a two-way street. We just heard the Deputy Secretary of the Treasury, Michael Falkender, refer to the rare earths component of the accord that was inked with Beijing during talks in London. And this is going to be a continuum. As part of those discussions, Tim, you'll remember, the U.S. agreed to lift restrictions on those H-2 20 AI chips that NVIDIA makes, something that China very much wanted to have in its market, and something that very much NVIDIA and its CEO Jensen Huang wanted to see sold in the Chinese market as well. So you do see chips and airplanes and others being used as bargaining tools in these talks with trading partners.
Michael, who holds these countries accountable, making sure that they follow through with their promises to buy certain goods or services from the U.S.?
You know, Tim, I love this question because when you go back to the first Trump administration, toward the end, they reached that phase 1 trade accord with China. This was in January 2020. It was before the COVID-19 pandemic really hit and paralyzed the world economy. But there were all sorts of promises by the Chinese to make purchases of U.S. grain, particularly soybeans. But those promises, according to officials in the Trump administration at the time, and then the Biden administration, were never quite fulfilled. And there's always been a lot of misgivings among trade officials here in Washington that China never quite followed through on those agreements. So it really does fall to the Commerce Department and the White House to go back and make those checks. And also the companies that have made those sales agreements themselves to make sure that not only are the products being produced, but they're actually being delivered and the purchase agreements are being sealed. And they can then take their misgivings or complaints, if they have any, right back to the politicians who wrote those agreements in the first place. But it is something we're going to have to watch very closely because we are seeing a number of promises and maybe not a lot of fine print so far in the handful of trade deals that we've seen from the president.
Yeah. It's kind of interesting, too. I'm just looking at some of the most read stories on the Bloomberg, and one that, has certainly caught our attention, Michael, is about Americans paying for the president's tariffs, not foreign companies. And they talk about GM basically choosing to absorb the blow, right? We talked about the dent of more than $1 billion to its profits, but that's not necessarily the case. And we're all just kind of waiting, I guess, for what the final tariffs are with all these countries and then what it really means for goods. But I mean, somewhere either companies' profits are going to be hurt or consumers' pocketbooks and wallets are going to be hurt.
Yeah, and Carol, I've heard so many different takes on how the cost ultimately will be borne. And while the president and a number of his aides will say that China will bear the cost, really the tariffs are paid at the border at the moment of import. And it's borne initially by the importer and then by the middle company, middle person, and then the consumer. But it's difficult to say exactly how much gets passed along to the very exactly how much gets passed along to the very last buyer in the chain, and that is usually the consumer going to the store, buying that good. Companies do have a little bit of leeway with their profit margins. Profit margins are a little bit higher in certain industries, enough so that they could absorb a little bit of the blow and not have to pass everything along to consumers. We heard our colleague David Welch earlier today on Bloomberg Radio talking about this, about how car prices are now historically high, and it's tougher for the car makers to actually pass on the full price of the tariff. But they're going to find other ways. They'll find it in terms of fees and other things that they tack on that they can not have to bear the entire blow all themselves. But as you say, Carol, we don't know exactly what the tariffs are going to be on all countries and all categories of goods. Right. This is a policy that's still taking shape, and we're going to know for how much, for months even, what it's going to look like.
When car makers start charging us for those rust undercoatings again, we'll know they passed it on.
You want to make sure you get that if you're going to be driving in an environment in the winter that has salt on the roads.
You don't do it anymore.
You don't do it anymore. General Motors, though, did have its worst day since January. Shares fell 8.1%. The company said it suffered a $1.1 billion billion profit hit from President Trump's tariffs. It's also revealed no plan for a near-term fix to return to pre-tariff profit levels. It raises the question, Michael Shepard, about what companies can do to try to rectify a situation after, decades of playing in an environment that was free trade.
Well, that's right. And they have been accustomed to this free trade, low tariff environment. And it is a massive adjustment that they have to make very quickly. And it is difficult to go to this administration and really try to contest them just on the tariffs point. Many counterparties, trading partners, including in Europe and Asia, have really just come to accept that, look, we are going to have to pay a baseline tariff of something on whatever we export to the United States. And companies have also come to terms with, look, we're going to have to just deal with a tariff environment. This is central. It's a central tenet of the president's agenda. It is something that he is really set in carrying out and delivering on. But what they are trying to do is try to minimize the blow. And they are pushing back against some of the more eye-watering tariff levels that we've seen. The European Union in particular is worried about this prospect of a 30% tariff on their exports to the U.S., and that is the subject of intense negotiations now. But for companies like GM, like Stellantis and others that have to worry about, okay, how do we deal with this now? There is some short-term pain involved and then some potential realignment. And what Michael Falklander was talking about also is maybe reshoring some of that manufacturing too.
Hey, Michael, one thing I want to ask you just to wrap up. You guys are there, obviously, in the nation's capital. I'm curious about the D.C. newsroom. I'm also curious about inside.
The snacks that they have?
No,
what are you curious about?
No, inside the Beltway.
I heard they're good.
Stop.
Sorry.
Inside the Beltway.
They are.
Stop, you two. What everybody's really focused on, because as Joe Matthews said, we have a White House that's very good at kind of shifting our attention. And so we're talking a lot about tariffs and trade again. Jeffrey Epstein has been certainly in the news a lot. The future Fed Chair Jay Powell, you had the president talking about, maybe removing capital gains tax on home sales. What is it, though, that really is front and center for most folks there in the nation's capital?
Well, the very first question that came up during this pool spray appearance with the president of the Philippines was the future of the Fed chair. It is top of mind for many in Washington. What is going to happen? It's a consequential decision with institutional implications. And the question is, what does this mean for the independence of the central bank? That's been a tenet of the Fed ever since it was created more than a century ago to try to bring economic and fiscal and financial stability to the U.S. and to the global financial system. And if the Fed's independence is being challenged, what does that mean? So the consequences of that are really enormous. But you did bring up the Jeffrey Epstein saga, and that, of course, has barged into the headlines here. It's gaining a lot of attention, and it's caused some questions even within the president's own caucus and base of supporters about whether this administration is delivering on its promise to be as transparent as it said it would about everything that happened involving the disgraced financier, whose story we all know so well, and we don't really have to go into all of the details of it here, but it has really captured the imagination. And trade, of course, is very much top of mind on Capitol Hill, on K Street, and certainly in newsrooms across the city, because again, like the Fed chair, it has enormous economic consequences with lasting impact too, Carol.
Yeah, big stuff, lots of stuff. Great summary of it all. Michael, thank you so much. We, of course, been talking to our Michael Shepard out there in the Washington, D.C. News Bureau for Bloomberg News. He is senior editor for technology and strategic industries, really pulls in all the macro, certainly into technology and just overall D.C. policy. All right, folks, you are listening and watching Bloomberg Business Week. What are we going to talk? Late night?
Oh, we're talking late night. Felix Gillette is going to be by.
All right. You're watching Bloomberg Business Week Daily. This is Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a 7% plus drop in shares of Texas Instruments after hours. TI declining after giving a revenue forecast that fell short of the most bullish estimates. Revenue will be $4.45 billion to $4.8 billion in the third quarter, though the average analyst estimate was $4.57 billion. Some projections did reach $4.8 billion. Capital One up after hours. It reported adjusted EPS for the second quarter that beat the average analyst estimate. Capital One up by 1.5%. A record today for the U.S. stock market. The S&P 500 index advancing again. Over 400 shares in the S&P 500 climbed, outweighing a slide in tech companies. S&P today up another 4 points to 6309, up under 0.1%. The Dow up 0.4%. Tough day for tech ahead of Alphabet and Tesla earnings tomorrow. NASDAQ down 0.4%. The NASDAQ 100 index down 0.5. Our Mag 7 index also down by 0.5%. 10-year yield 4.34%. Spot gold up 0.9%. 34.28 the ounce. And West Texas Intermediate crude down 1.5%. 66.21 a barrel. So it is an up day, a record for the S&P 500 index. Leo Kelly is the CEO of Verdance Capital Advisors, and he was interviewed about the market right here on Bloomberg Business Week Daily.
We're actually pretty bullish. There's a lot of investment coming to the U.S. We have earnings are starting to gain a little momentum. AI productivity is going to be significant. So there's reasons in the intermediate term to be bullish, and there's a lot of volatility, I think, headed in front of us in the fall.
Leo Kelly of Verdance Capital Advisors, interviewed right here on Bloomberg Business Week Daily. Recapping, S&P at a record, up another 4, up 0.1%. Texas Instruments after hours, down 7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. The big question a lot of people have been asking since last week's news, is it the end of late night TV? As you know by now, The Late Show with Stephen Colbert will air its last episode in May of next year, marking the end of the franchise.
And now for the next 10 months, the gloves are off. I can I can finally speak unvarnished truth to power and say what I really think about Donald Trump, starting right now. I don't care for him. Doesn't seem to have like the skill set. Doesn't have the skill set to be president. You know, just not a good fit. That's all.
That's Stephen Colbert. The Late Show with Stephen Colbert. He's been a vocal Trump critic, so prominent entertainers, journalists, and a prominent Hollywood union, they were quick to suspect Paramount's motives. The move, after all, comes as David Ellison is looking for his deal for Paramount to close in the next few months. And CBS recently settled a lawsuit brought by Trump that most legal experts considered without merit. For this, we had to get somebody who knows a lot about TV. And that's why we're bringing in Felix Gillette. He's Bloomberg News media and entertainment editor. He's also the author of the book on HBO. It's called It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. He joins us from New Jersey. Felix, do we know now if this was a 100% business decision, if politics were involved, or is there another factor here?
I mean, I think you have to weigh both factors, the business and the politics. You know, CBS came out and said, look, it's just entirely for financial reasons. Obviously, all these people have come out questioning that, you know, Elizabeth Warren, Bernie Sanders, other hosts in late night, even Paramount's other star, Jon Stewart, everyone saying, well, come on, you kind of lost the benefit of the doubt once you paid that settlement to Trump. You still have this tricky dance going on in Washington trying to get regulatory approval. You know, so I think it's a little bit of an open question, but even that said, I mean, you have to say the late night format has been fading for a while. The numbers just look terrible across the board for the big three. They're losing their audience. They're losing their ad revenue. You know, just 5, 6, 7 years ago, those shows were still profitable. And now, you know, we're seeing reports that, you know, The Late Show was losing tens of millions of dollars a year. The advertising has dropped off by, you know, $40, $50 million in the past 5 years. And it's really hard to justify, the show and a staff of 200 people in what are very lean times and growing leaner in broadcast television.
But why now? Was it bad last year too, or did it all of a sudden become increasingly not a great business?
It's been going downhill pretty steeply since COVID. And I think probably why now is that the network is looking forward to next year's numbers. They're putting together budgets. They're looking at, where they're going to spend their money in 2026. And, from what we're hearing is they did look at, could we cut the costs in the show? The show costs, more than $100 million a year to produce. Could they do it for less and maintain the format? And I think at a certain point they said, you know what? We're not going to spend that money. It's time to call it quits. Also, at the same time, there is political benefit for the network potentially to do this. And so how much of that influenced the decision? Jon Stewart came out last night on his show and accused the network of, pre-compliance. I think it's got to be a mixture of both factors. And, the truth is the numbers are not going to get better. It's kind of wild because, across the board, you look at comedy and the internet and social media and streaming has been great for comedy and all these other formats. I mean, comedy clubs are doing really well. Big live comedy performances at stadiums are doing really well. Comedy podcasts are doing really well. The one thing that is not doing well in this current area of media consumption is the comedian-hosted late-night talk show. And it just has not transferred to this new era. And, Netflix has tried, multiple times to kind of replicate it. And, Netflix has been able to replicate, live sports. They've been able to do these hour-long dramas, reality shows. All these other formats have transferred to the streaming age. Every time a streamer has tried to do kind of a standard late-night talk show format, it hasn't worked. Chelsea Handler, they did one. Joe McHale, Norm Macdonald, Michelle Wolf. So it hasn't been the talent. It's just really people don't want to watch topical talk shows that are kind of skimming the news of the day. The format was always, you had to watch it at that night, and it was somewhat of a disposable format. It just hasn't transferred to that on-demand world. I would say the one exception to that is if you look at HBO, John Oliver, his show has done well, but that's a really deep dive into one subject once a week through a comedic lens, and it has shelf value in 3 months, in 6 months. You come to it a year later, the topic is still interesting, it's still valuable. And, that's really not the case for a monologue that, is riffing off the news of the day. 3 weeks later, it's not really relevant.
Hey, Felix, just got about a minute left here. Can we make the jump that this isn't a political decision in that they're leaving him on air, right, for the rest of the year? And so,
until next year.
Or until next year, excuse me. And so there's a lot that he can say in the meantime. So can we make that jump that, right, if it was a political decision, they might have yanked him right away?
Yeah, they could have canceled right away. But at the same time, they do get some benefit from, it made Trump happy. He jumped on social media and got to claim victory and claim a scalp. So, he's going to be on the air until May. He's going to be hammering away at the Trump administration and might be hammering away at Paramount and CBS. But so they get a little bit of benefit. I don't know. I can see it both ways.
Do you think that Jimmy Kimmel is next, as the president has said in social posts? Just 20 seconds.
Yeah, 100%. I think, but not because of politics necessarily, but for the same reason that the Late Show was on the chopping block, because of the economics and because of the audience and because of the loss of advertising revenue. Jimmy Fallon is, I think, slightly more protected on NBC because Lorne Michaels, producer of the show, has more clout with Comcast with NBC. It's the Tonight Show has a longer history that might survive a bit longer.
Felix Gillette, Bloomberg News Media and Entertainment editor, also the author of It's Not TV. Be sure to check that out. All right, folks, coming up next, Stocks on the Move right here on Bloomberg Business Week Daily.
You're listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we're getting ready to wrap up on the Tuesday edition of Bloomberg Business Week Daily. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Brokers studio. As we mentioned, stocks, new record on the S&P 500, up 4 points. Dow Jones Industrial Average up 179 points and 116 to the downside for the NASDAQ 100.
Tomorrow, the big day, Alphabet earnings after the bell, as well as Tesla. Those two companies reporting after the bell. We'll bring you those numbers as soon as we get them. Expectations are pretty low for Tesla, Carol.
Yeah, exactly. Commentary should be interesting, especially with the story today that in the filing for SpaceX that Elon Musk is going to kind of continue dabbling in politics. I'm Carol Massar, along with Tim Stenovec. Let's get to some of the stocks on the move today. Bloomberg News earnings reporter Red Brown. This is his really busy time here at Bloomberg. He's got some stocks on the move. D.R. Horton, the home builders were on fire today.
Yeah, they were on fire today, and it's because of D.R. Horton's earnings today, actually. The ticker on this one's DHI. The company was up around 17%. That's its best one-day move since I'm looking at it now, and it looks like since 2020, so since 5 years. Prior to this, the stock had been down around 6% through the close yesterday, so this is really kind of reverse fortunes for this company, and it's dragging a lot of its peers up as well. So the company actually increased the top end of its range for its sales target and mostly maintained its target for how many houses are to close this year. So really positive report, especially kind of considering just, everyone's been watching the housing market. It's been quite soft this year. It's soft because mortgage rates are elevated, home prices are elevated as well. So the company now is trying to make some effort to make some homes more affordable and start to stimulate demand through some incentives, things like that.
How come D.R. Horton and not Pulte?
Because Pulte, I think they report tomorrow, I believe, and D.R. Horton is a little bit bigger as well. So I think for our lovely listeners,
they were up too.
They were. So
everyone in sympathy, as Red said.
Yeah. So it was Pulte and Lennar also were up. They should be reporting quite soon here, I think, in the next couple of days. So we'll see if we get kind of a similar result, or maybe D.R. Horton is just kind of a one-off here, because they all do kind of dabble in different ends of the market. Like I think Lennar, if my memory is serving right, is a little bit more high end.
Wait, but Pulte came out with earnings too today.
Oh, did they? Look.
Yeah.
Oh. I'm not doing a very
Only
good job.
because you're stressing me out because I talked about them in my gainers and I'm like, shoot, did I read this wrong? Right? 6:30 this morning?
I don't know, Carol.
Second quarter adjusted EPS?
Looks like they did.
How did they do? They did well as they also beat revenue, beat EPS. So
stock was up 11% today.
There we go.
Sorry.
So it seems like home builders I guess across the board. Then I guess would be the conclusion.
Tim and I have talked about it. It's kind of wacky world right now, bizarre world.
Yeah.
So they did report, right?
Yeah, they did.
Okay.
My mistake.
No. I'm all of a sudden thinking I talked about it in my gainers. I'm like, hey, Pulte reported earnings, and
Let's talk about
It's a
Zyn.
weird day.
Yeah.
I want to talk about Zyn because every time I walk by Carol's desk, she's just grabbing one of these Zyn pouches and she's like, Tim, you got to try this Zyn stuff.
That is so not true. Anyone who knows me, so not true.
Well, it's interesting that it's not true. I mean, it seems like everyone is actually
It's a
doing
joke. It is not true at all. But talk about Zyn a little bit.
I mean, that's how she gets her edge.
Yes.
She's so
All right,
These
go
are
ahead.
nicotine pouches.
Yes, they are nicotine pouches. I'm sure many people are familiar with them, increasingly so. But Philip Morris, who sells these Zyn pouches that you're seeing everywhere, actually fell around 8.4% after their shipments of Zyn pouches in the U.S. missed expectations. Shares have done really well this year. They're up nearly 40%, and that puts it around the 25th best performer in the S&P 500 last time I checked. So, and that actually largely is due to the strength of their Zyn business so far. It still grew 42% last quarter, so it's been up around 40% each of the last 3 quarters.
No Zyn pouches here. I'm just telling you.
No.
Body is a temple.
Is it because they're competitors now to Zyn?
I think so, because if you remember, Zyn had those manufacturing issues, right? So they weren't able to. It was late last year, for a period last year, they had some manufacturing issues, so they weren't able to meet the demand. And I think that probably did open up a little bit of a window for, you see all these like knockoffs and they all look kind of the same. But I think, for something like this, I don't know how people had their cigarettes, right? Like you would smoke whatever it was.
Right.
I don't know if the sort of like loyalty is the same. If it's like, I'll just grab whatever's available to
Let's
some
ask
extent.
Tim. Are you loyal? Like, do you have a certain Zyn pouch that you stick to?
I would never.
I know. It would never be for Tim. I would, End of the world if I see
As
that.
Red said in our own Bloomberg News team reporting, the company was dogged by manufacturing problems last year. Capacity constraints caused Zinn shortages that have now eased. It announced investments in new facilities and said restocking was completed in the first half, though the impact on sales was slightly less than expected.
All right, so we had D.R. Horton, ticker DHI, right? We had Philip Morris, MO, and now we're going to go to NOC, Northrop Grumman.
Right. Northrop Grumman, yeah. I mean, this one was interesting to me today just because of the kind of contrasting fortunes in defense. We also had Lockheed also reporting earnings today, and they fell around 11%. Northrop, the ticker on that one is NOC, and they were up by around 10%. They actually hit an all-time high in the process. It's one of their best days in the last 2 or 3 years. So, bringing total returns up to 20%. So still doing really strong. Wow. They raised their full-year outlook, and that's despite kind of some of the pressures that the Trump administration is putting on the kind of the defense industry overall, kind of trying to rein in some procurement, trying to make the whole industry a little bit more competitive. It's a very opaque process to kind of actually get a contract, but it seems like Northrop is still benefiting from a couple of the programs that they have already. They have a ballistic missiles program, they have a bomber program, and those do seem to be kind of making healthy returns. And the big thing, the big number for all this group is the backlog. The backlog grew 8% last quarter. It's nearly $90 billion now. So that's quite a healthy book of business for the company to kind of on the back of just governments across the world prioritizing defensive spending.
Some nice visibility, right?
Definitely.
Give them. By the way, Northrop Grumman is up about 20% year to date.
Lockheed was one of my decliners, and I couldn't even talk about it today because earnings came out. You got to do your gainers. I didn't get to do. It's okay.
Red Brown, thank you so much. Check out Stock Movers podcast, Winners and Losers. You can find it on Apple, Spotify, or wherever you get your podcasts.